In New York City, I'm Shauna Smith alongside Brad Smith. This is Yahoo Finance's flagship show, The Morning Brief, the ultimate guide to help investors make smarter decisions for their portfolio. We're tracking early session volume while bringing you today's top market themes and elevating Yahoo Finance's most popular newsletter.
That's right. We've got a very busy Wednesday ahead of us here. Futures ticking lower as investors' focus is fixed on Nvidia's highly anticipated earnings results after the bell today. The AI chip darling posted its worst day since October 17th as investors are awaiting this release. Plus, Palo Alto's disappointing quarterly results could prove as a warning sign to Nvidia, potentially putting an end to an AI-driven rally we've seen this year. We will see, though.
So we got the AI trade, and then we also have what the Fed is doing. Notes from the Fed's most recent meeting could shed some light on what will eventually prompt that first rate cut. Traders pulling back their bets for an early move by the central bank. Those minutes are going to be released at 2 p.m. Eastern time today. So let's get right to it. The three things that you need to know, your roadmap for the trading day. Yahoo Finance's Dan Halley, Madison Mills, and Jared Blickery have more.
Right, Nvidia is putting the recent AI-fueled rally to the test. The AI chip darling is announcing its fourth quarter earnings results after the bell today, and it's certainly one of the most highly anticipated reports in recent memory. While shares of Nvidia are in the red this morning, the stock has skyrocketed over 220% in the last year, easily outpacing rivals AMD and Intel. Revenue is expected to jump 234% annually, and analysts are keeping an eye on Nvidia's forward guidance.
And Pacific Northwest nosediving off of their quarterly results. This comes after they updated and cut their forward guidance both for revenue and billings. The CEO said that was due to a strategy shift, but that exact shift is what's going to accelerate growth for them in the future.
All right, and we're also tracking shares of Walgreens and Amazon. Amazon taking over at least when it comes to replacing the second largest pharmacy chain in the Dow Industrial Jones Average. Now, the move is taking place next week, and the revision was prompted by Walmart's 3-for-1 stock split, resulting in lower index weight for the company. Shares of Amazon ticking higher in the news in pre-market trading following the announcement, while Walgreens shares are moving to the downside.
Well, today is a big test for the AI rally. Nvidia is set to report after the bell. Stock futures, they're lower this morning, pressured by Nvidia's declines. Now, the chipmaker lower once again in pre-market. This comes after it suffered its worst day since October. Now, Nvidia has been a huge driver of the market's gains. Putting that in perspective, it's actually accounted for about 30% of the S&P 500 gains this year. So what should we expect tonight, and what does that mean for the broader market? Here to break it all down, we've got team coverage. Dan Halley, Josh Schaefer joining us at the desk. So guys, let's talk about just how critical this is going to be for the market. And Dan, whether or not you think Nvidia can and will actually live up to all the hype.
Yeah, I mean, the expectations are through the roof for this, right? They blew away expectations in the prior two quarters. They had this huge forward-looking guidance that really, I think, had everybody stunned out of the gate. Originally, they had to revise up their guidance, I think, a few quarters back. And so, you know, a lot of this is going to come down to, are they going to beat? I mean, that's obviously the big thing. But then what is the guidance going to look like? What does it mean when they see, okay, we're continuing to see people want to get these chips. We're continuing to see people get the most expensive chips, the H100s. And I think that's really going to be the big difference here for them. You know, we're seeing more competition, but no one's really caught up quite yet. AMD is the closest. Intel is still, you know, pretty distant at this point.
It's going to be interesting, Dan, to just see how the stock moves, right? We talk about how much this stock has rallied just in 2024 alone, and it almost feels like there's only so much room to run here, right? And I think that's important to set as an expectation for investors just coming into this, because Nvidia has had very impressive beats going back several quarters now, but think about how the stock reacted last quarter. Yeah. The stock didn't exactly skyrocket, right? Because sort of you're seeing that pricing in happening over the last couple weeks as other tech companies mentioned that they want NVIDIA chips, right? That was part of the run up here that we've seen. So I think overall, when you think broader market, it's not necessarily like you can maybe expect, or you should expect, NVIDIA to be carrying the S&P higher tomorrow, carrying the Nasdaq higher. If anything, maybe the concern is actually something to the downside.
Well, the first kind of look that we have at what the potential move could look like, Options AI has some data on this, and based on where they're seeing contracts kind of net out for post-earnings moves here, we're looking at an absolute value of either 9% higher or lower here. So that's the type of expectation that investors can have going into this, and it'll really be a question of what NVIDIA says that also continues this kind of rising tide type of mentality as well here, and where that permeates throughout the rest of the markets.
You've seen that in a lot of these other stocks, right? Stocks that Dan covers around the tech sector. It has been the AI hype cycle. NVIDIA kicked that off, right? And so what are they saying about it? But Dan, I'd be curious your thoughts on just, even if they come out with maybe a slightly more tempered expectations than people expect, it feels like that doesn't change the AI story overall, right? It just might be maybe a one-day blip.
Yeah, I think it's interesting, right? Because there's, like you said, there's only so high it can go after earnings, and I think that's one of the things to keep in mind is, I think the AI discussion is still not completely understood by everybody, right? I kind of hammer this point a lot, is that AI has been around for a very long time, right? It's in everything we use. It's in cars, it's in phones, it's in our smartwatches, and I think that's something to keep in mind. This is all based on generative AI still. That people started to really go crazy for this. I think when it comes to the overall story, though, it's going to come down to how companies like Microsoft and Google and that ilk see the growth for their products, right? Microsoft had said that AI had given a 6% revenue bump, right? 6% to their overall revenue for Azure, not overall. And I think that's important to keep in mind. So, I think it's really going to heavily depend on the overall AI story, where companies like that go as far as growth. For NVIDIA, it's going to be, well, everybody wants these chips, and everybody's going to continue to try to move forward with AI. There's going to be a need for them. So it's almost two different stories in this, larger bubble of AI, not necessarily that AI is a bubble, but this overarching story of AI. But yeah, I think it's almost two different stories at this point.
Yeah, at the same time, you mentioned Google out with its own Gemma this morning, more of the open source generative AI platform for developers there. We'll see what comes forward from some of those announcements. Also, Dan, Josh, thanks so much for taking the time, teeing up all things NVIDIA for later on today. Let's take a look at today's stock to watch, though, here this morning. And we're tracking shares of Palo Alto. They are tumbling in pre-market after cutting its full-year guidance. Yahoo Finance's Madison Mills is on the floor of the New York Stock Exchange with more on this. Hey, Maddie.
Hey, Brad. So Palo Alto nosediving over 20% since their earnings print. They'd only tumbled by that much one other time in the stock's history, and that was in 2017. So just some context to indicate the degree to which the street was disappointed in these results. Now, what's interesting to note is that this is part of a strategic shift for the company, and the CEO talked about that on the call, saying that they're hoping to become a service platform rather than just a cyclical service that a company might outsource quarter to quarter. They want to join the likes of a ServiceNow, of a Workday, and those platforms we know have seen a lot of success. Having said that, they need to work with their customers to make sure that adoption of those platforms is more seamless, and that's exactly what the CEO said they're going to be doing moving forward on the call. Now, what's interesting to me is what happens when you look at the numbers. They beat on the top and bottom line, but of course it's all about that forward guidance. They cut their guidance just ever so slightly here, and that indicates to me, both on revenue and billings, by the way, that it's this broader picture that we've seen throughout this earnings cycle, that if you are not beating by double digits, if you're not also updating your forward guidance higher and higher, particularly if you are in one of these AI-driven sectors, and Palo Alto considers itself one of those AI plays within the cybersecurity space, you are going to get punished by the street. And this is an indication to me of what we need to be looking out for ahead of those all-important NVIDIA earnings coming out later today. Even if we see some beats in the major areas of the print, could that forward guidance lead the stock to tumble? I know that's what we're spending a lot of the show talking about today as well. Interesting to note, though, for Palo Alto moving forward, is this strategic shift that the CEO mentioned going to be able to bump up that forward guidance in the future, guys?
All right, Madison, thanks so much. We'll check back in a little closer to the opening bell. Well, it is a big day on Wall Street for AI. There are high expectations for Nvidia reporting its fourth quarter results after the bell, and investors have been retreating from the AI juggernaut, sending shares down over 4% on Tuesday at least. Nvidia, along with another big AI play, Palo Alto Networks, pulling broader markets down with them. So what impact can we expect artificial intelligence to have from here? We've got Joanne Feeney, who is the Advisors Capital Management Partner and Portfolio Manager. Joanne, great to have you here with us this morning. Just AI as a portfolio play right now, where is the setup now coming off of Palo Alto and going into Nvidia from your perspective?
Yeah, good morning, Brad. There's a lot of opportunities in AI. Obviously, NVIDIA is among the most attention-grabbing of them, and rightly so. It's the picks and shovels, right? It is what makes AI applications possible. And so it'll be interesting to see what they do tonight. We can talk more about that. But there are a lot of other ways to invest in AI. There are other chip companies, like you mentioned, AMD, but also Broadcom. And then there are also the software companies that are developing those applications, whether it's a Snowflake or a ServiceNow. There's other hardware companies rolling out AI capabilities embedded in their products. So there are a lot of ways to capture the value that AI is likely to bring to a lot of different sectors of the economy. And we're playing various options there, not options in the financial sense, but various investments there, depending on the strategy. Because, NVIDIA is not for everybody. It's a higher multiple, riskier position. It's going to be more volatile, may not be appropriate for, say, an older investor who's looking for income out of their portfolio, right? So it really depends what your strategy is, what your goals are for investing, how you want to play AI. But there is a solution, there is an opportunity for every type of investor here.
Joanne, let's talk about what we heard from Palo Alto Networks after the bell yesterday. Obviously, some concern there. There has been some commentary this morning saying that maybe this signals weakness that we could see more broadly across the AI landscape. If we do see NVIDIA disappoint on any metric tonight, what do you think the impact is going to be more broadly across the sector? Could we see a number of these AI names under pressure as a result?
It's entirely possible. I mean, clearly, NVIDIA's outlook is going to shape the investor view of what is possible from AI and all those related AI plays. But I think that you have to differentiate between the capacity to run AI training and inference models, which is what NVIDIA is enabling with all its super duper graphics processors. You have to separate that from how AI is being developed in applications. And, one doesn't necessarily imply, the other. So if NVIDIA, for example, has a little bit of a slowdown in the sales of its chips, which, by the way, we think is unlikely, it doesn't mean that services companies aren't picking this up and seeing lots of sales related to AI. So I think it would be a mistake for investors to read too much into NVIDIA's results, particularly on the application side.
Where did you expect some of that? And eventually there is going to be a life after NVIDIA that we have to think about too, in terms of some of the massive run-up that we've seen. There's these different pillars of generative AI where you've got the applications that sit on top of the language learning models and those models that sit on top of course, the chips powering the data centers as well. So where is that next portfolio pivot, perhaps, that's still within generative AI, but is later on towards the kind of consumer appreciation or realization of being able to have hands-on some of these solutions?
Yeah, right. So you've broken it down really nicely into you think about three buckets. First, you've got the chips that make it possible to build the servers to run the AI training and inference models. Then you've got the folks building those servers and making those services available to not just the consumer through, say, a ChatGPT, but also to other software companies that are then developing novel ways to use AI. So there are three areas. So yeah, you can say, okay, at some point, the growth in the sale of the chips may slow down, right, eventually. We're, I think, a long way from that, given how much demand is sitting out there. But then the consumer-facing opportunities we think are in companies like Amazon, Microsoft, Apple, and other potentially social media plays or retail plays. So what did the consumer get out of using large language models like ChatGPT? So that I think that the Microsofts and Amazons of the world are going to have a very long runway as more and more consumer-facing applications get developed. And then the third bucket are software companies developing applications for, say, the business world, for how to run your factories better, for how to manage your operations more efficiently. Companies like ServiceNow, Snowflake, companies like Palo Alto, who are going to make cybersecurity smarter than it has been able to be in the past, which, by the way, is a company we've owned for a long time, I think since the last time its stock fell off a cliff. And we shouldn't read, by the way, too much into that slightly weaker forward guidance. We think the moves they're making here to change slightly their business model and their go-to-market strategy is actually very smart from a perspective of getting over the big switching costs that their new potential customers face.
Joanne, the drought that we're looking at here, off just about 25% pre-market, it sounds like you think it's an overreaction.
Oh, yeah, I really do. I think what you have is a lot of, short-term holders that recognize that, hey, the next few months could be a little bit bumpy. They've clearly brought down their orders guidance, and I think that's really hurting the stock. And there are questions about how much growth they can generate in the next 6 to 12 months because of this shift in go-to-market strategy. But when you look into that shift, what does it portend for the future? And you see a lot more potential for the company to take market share, which ultimately is a very good thing for where they're going to end up in, say, 2 years. So long-term holders should view this as an opportunity. If feel like they've missed Palo Alto, this is a great opportunity to get in. They have a modest position, this might be a really good opportunity to increase the size of that position. Because ultimately, this strategy that they've rolled out, that I talked about last night, is one that's going to help them gain market share with bigger contracts with longer duration. And it's going to be a little bit painful up front because they're going to basically give away some services while they're helping their new customers to transition. But ultimately, it's a really good strategy.
Yeah, certainly. Well, we have seen some of that concern being stretched to some of their competitors out there, CrowdStrike, Fortinet, Zscaler among those in the red today. And what you're saying might be an overreaction on those stocks as well. All right, Joanne Feeney, Advisors Capital Management Partner and Portfolio Manager. Thanks so much for joining us here this morning.
You bet.
Well, coming up, we're going to break down Yahoo Finance's top trending tickers. Plus, stay tuned for our conversation with Fubo TV CEO David Gandler. He joins us in the next hour. Big news filed after the bell yesterday, filing a lawsuit against a recent team-up play here between ESPN, between Warner Brothers. We're going to talk all about it next hour. The Dow Jones indices stirring up the makeup of the Dow Jones Industrial Average. Amazon set to join the index, taking the place of Walgreens Boot Alliance. That change takes effect prior to the open of trading on Monday, February 26th. Now, here to discuss the methodology behind it, what it means for that average investor, we want to bring in Howard Silverblatt. He's S&P Dow Jones Indices senior index analyst. Howard, it's great to see you here. So just talk about the significance of this change and what it means to the average investor out there just in terms of their industry exposure going forward.
Well, it's only 30 issues. It's not like the S&P 500. And we do not change the index. S&P does not change the index too often. It's been about 60 changes in 127 years. So change is a major item, a major consideration. At this point, the thinking basically is obviously the economy and the markets have changed and we needed additional exposure. And Amazon offers that exposure at this point in time. Also, Walgreens has somewhat declined in stock price, so since it's price weighted, doesn't have that much of an impact on there. If you wanted to stay in that field, you would have to find a higher priced stock in there. We also had Walmart's 3-for-1 stock split that reduced the weighting within the index. So again, the index needs to stay relevant and reflect the higher end of the U.S. markets on here. And Amazon was a natural selection at this point. Consumers, enterprise, different areas, the exposure that it gives to the index. For the average investor, it'll mean that the index itself is more reflective of consumer selections at this point in time. And that happens on a regular basis. To some degree, Amazon is no different than when we put Sears Roebuck in the 1920s. It's still a retail where consumers are going. By the way, Sears was taken out in 1999 for a company called Microsoft. Again, the index needs to be relevant. We do not like to change the memberships in there. We'll prefer the consistency, but at times it has to be done because as the economy changes, the index has to change.
When you have a company like Amazon that is a beneficiary of so many different segments within its business, whether that's cloud or whether that's its investments or its play in AI or the consumer and strength or resiliency of the consumer, that relevancy also can kind of lead to being lighter fluid when they are especially beneficiary of so many different areas and potentially propel the Dow to, 40K very soon as well? And so what type of relevancy as you make these changes, as we consider in the markets, digest these changes, how does that propel us towards some of those other all-time highs as well for the Dow?
Well, in this case, the actual mechanics of the split and adding Amazon actually did increase the target price. That's the estimate for 1 year, not from S&P, but on the street. We do not choose stocks based on whether we think they're going to be going up or down. Actually went up to over 42,000 for the 1 year. From the 41,000. As far as the Amazon makeup, yes, some of the other fields that it's getting its sales from and some of its profits that are still growing is somewhat of a plus because it's developing and it's giving you a bit of exposure in a few other fields where we would have wanted to increase on it. But mostly you're dealing with the consumer sector, the retail sector, where the bulk of it is in right now. And that's positive because the consumer is the biggest part of the economy in there. And again, at this point in time, we're better able to reflect it. And the 3-for-1 stock split was kind of the catalyst to the event at this point in time. It wasn't the major reason. You're always reviewing what's in and what's not in the index. And again, you try not to do a lot of changes. So you really need a reason to be taken out to some degree, such as a merger or a deterioration or a relevance in your price.
So, Howard, we have that change. We also have Uber replacing JetBlue in the Dow Jones Transportation Average. Talk to us just what this tells us about current industry trends.
Again, similar in nature here. JetBlue did kind of decline in its price, so its relevance within the Dow Jones Transportation was minor on there. Uber is a very popular stock. Again, as far as expenditures go and consumer. And the intent here on the transportation is to look at the ground transportation as well. I mean, outside of Avis, there's no real ground transportation in the Dow transportation itself. So Uber was a good fit into there to giving it the exposure, again, to expenditures. The Dow overall is actually transportation, which was originally the Dow Railroad, is the oldest existing indice, even before the Dow Jones Industrial Average came into play. It was originally known as a railroad industry, and there are 11 issues in it.
Such a great pleasure to always get your insights here. Howard Silverblatt, S&P Dow Jones Indices Senior Index Analyst. Howard, we appreciate the time as always.
Thanks for having me.
Thanks. Time for a trending ticker that we're watching on the Yahoo Finance platform, Teladoc. The shares plunging after giving a weaker than expected first quarter and full year forecast. The company's CEO warning that the virtual care market is well penetrated and now expects revenue growth of low single digits going forward. You're taking a look at shares right now, down by about 19%. It was interesting on the call. They did say that they are looking to bring to market a broader range of services, areas like weight management, pediatrics this year, even as they work to achieve profitability.
Yeah, exactly. And this is a stock that clearly had a run up during the pandemic. We've seen it fall back, obviously, as not as many people are using those telehealth types of options now that many people have returned to an inpatient type of facility here. So we are seeing some pressure on that name. As a result, revenue outlook is disappointing just a bit. A lot of the analyst commentary reaction to these results have been surrounding the BetterHelp growth and lack thereof, the slowdown that we have seen within that division. Barclays, one of the companies coming out saying that they need to see or expect to see some stabilization in BetterHelp in order to have that meaningful recovery. So as a result, we are seeing pressure still across the business with Teladoc shares under a significant amount of pressure this morning. All right, well, coming up, stock futures ticking lower ahead of a key earnings report from Nvidia after the bell. You've got the Nasdaq off another 0.6%. It looks like it's going to open in the red today. We'll be right back with the opening bell.
Welcome back, everyone. We've got just seconds until the opening bell. The Dow futures, S&P 500 futures, and Nasdaq futures all pointing lower here this morning. A lot of anticipation for what's being said from the Fed today. You've got Raphael Bostic. He was speaking this morning, and that event was taking place in Atlanta at the Airports Council International CFO Summit. So we'll see what comes out of that. There was no webcast for it, so we don't immediately have some of those comments. But then also you got some interesting comments from Barkin out this morning too. So a little bit of Fed speak, and then additionally you've got, of course, big earnings day here. Nvidia is going to be in focus later on, and we will see exactly how that moves some of the broader sentiment around this AI-fueled rally as well.
Yeah, Brad, that is the big focus, at least in the near term here for investors. There's been so much hype surrounding AI. It feels like you and I have been talking about it forever, really driving much of that market rally that we have seen over the last 12 to 14 months. So there is a lot riding on these results. It's no surprise a number of the strategists, number of portfolio managers that we've been talking to, all saying that this report is extremely critical, not only for the AI trade, but for the broader markets as well.
Absolutely. You're taking a look at the opening bell on Wall Street. You've got the National Museum of African American History and Culture ringing the bell at the NYSC. And in Midtown Manhattan, you've got Consensus Cloud Solutions with some funfetti in the air there, throwing it up like LeBron James before game. All right, there we go. The markets are open, but they're down. We've got the coverage of the biggest market movers following the opening bell on Wall Street. Yahoo Finance's Madison Mills on the floor of the New York Stock Exchange, and Jared Blickery is on standby at the Interactive. Nvidia's had a tough week ahead of its earnings report. That is coming today after the bell. Madison, what are you hearing from investors around the exchange around that anticipated report?
There's a lot of activity here this morning, Brad, which is interesting given some of the wait and see that we've seen over the course of the last 24 hours, particularly on this shortened trading week. I'm hearing this morning that's not just because of those Nvidia earnings, it's also due to the Fed meeting minutes that are going to be due out later today. So traders waiting on that macro data as well. But zeroing in on the Nvidia returns, Goldman Sachs saying that this is the most important stock on planet Earth. And when you have that much attention on a name, Cameron Dawson this morning saying that, of course, there's going to be a lot of movement. The options market implying about an 11% move on Nvidia. That could be either to the upside or the downside. If it goes to the upside, that is going to be a record-breaking high for this stock. So anxiously awaiting that news to come later today. Having said that, earlier I know I was talking about Palo Alto, and I feel like the street's reaction to their earnings print, which was a beat on the top and bottom line, but that forward guidance was just a tiny bit of a change. That is an indication to me of just the amount of pressure that are on these big tech names to consistently have higher highs and beats on their earnings prints. If we continue to see that pressure today, that could imply a little bit of downward pressure on Nvidia. Having said that, Bank of America saying if you see a pullback, it's going to be brief. Highs beget higher highs, and that's part of why we're seeing a name like UBS even upgrading their price target for the S&P 500 to 5,400, even amidst all of this uncertainty as we await that most important stock on planet Earth today.
All right, Maddie, thanks so much for setting up the trading session here for us. For much more color on this, we've got Jared Blickery at the home base here at the Interactive. We mentioned more color, mostly red and green. Jared, what are you seeing on the screen?
Yes, unfortunately, more red than green right now. Small caps leading the way down about 0.7%. Tech is down, a tech-heavy Nasdaq down about 0.5%, and so is the Dow for that matter. Let's dive into the sector action, and then we can get to a little bit of big picture stuff here. But first, we got consumer discretionary. That is in the forefront. That is in the lead, up just under 0.5%, followed by energy, utilities, real estate, and staples. Some defensive sectors and mixed in with some cyclicals there. Interesting mix, but tech is decidedly down. That's down 1%. So is financials, down about 0.5%. Let us take a quick look inside the Nasdaq here. Amazon up about 1 3/4 points, but Meta down 1 point, Nvidia down 1.5%, Microsoft down 1% as well. I just want to point out that this is a seasonal time of weakness, and what I'm about to show you here, this is from Ryan Dietrich. He is saying, as we've noted for a few weeks now, to see some seasonal weakness the second half of February, that's right now, maybe till St. Paddy's Day. That would be perfectly normal. Plans are useless, but planning is everything. That's what President Eisenhower said. And here is the map for February. You can see the projected, what's expected is now to head a little bit south for a little bit. And we'll have to see if that's just sector rotation or outright downside action. But we're seeing a little bit of that downside action today, guys.
Well, yeah, Mike Tyson also said everybody has a plan until they get punched in the mouth. So we'll hope that Nvidia doesn't do that to us later on today, Jared.
Jared was all over that, Jared, and I like the
I've
whole.
been waiting my whole life for that. I can go home now.
Yeah, all right, Jared. Thanks so much. We can go home, yeah, because we're going to be checking in with you in just about a half hour from now. But let's get to it with some of the moves that we are seeing this morning, because stocks at the open still under a bit of pressure. You've got the Nasdaq off just about 0.5%. Of course, all of this ahead of that key earnings report that we have been talking about now all morning from Nvidia. Now, the results largely seen as a referendum on the AI trade and the recent market rally. Nvidia accounting for 30% of the S&P 500 gains this year. The S&P 500 hovering under that 5,000 mark since it did close above that benchmark level for the first time on February 9th. Now, our next guest saying that he still sees some upside for the broader S&P 500 index, 30% upside over the next 2 years. Let's talk about all that with Ed Yardeni. He is the president of Yardeni Research. Ed, it's good to have you here. So put this in perspective. We're focused so much on this Nvidia report after the bell. As a strategist here, obviously you're positioning for the longer term. How are you looking at results potentially from tonight and what that means for your strategy going forward?
Well, I think it's a very short-term story right now. Clearly, it's just going to happen today. And I think once the excitement of the expectations of what will happen, I think we'll find that the market settles down a bit. This is obviously viewed as a big deal, but overall, there's more going on in this economy than just NVIDIA or artificial intelligence. The reality is that the economy's proven to be remarkably resilient. It continues to grow at a good pace. Inflation's come down despite the fact that the unemployment rate remains below 4%. So it's been a great economy, and the stock market reflects that. And I don't think the AI story is the entire story here.
I mean, the high on the street for Nvidia and the price target is $1,200 here. So, I mean, it says a little bit more than perhaps a short-term story. But from your perspective, where is that long-term story that investors perhaps should be paying attention a little bit more here within the generative AI landscape?
Well, I think the AI is one of the technologies out there that are going to do a great job of increasing productivity in our country. We've got a significant labor shortage. I think that's the big problem we have in the economy. And one of the ways that we can solve that labor shortage is to see companies investing in technology and machinery and so on, and onshoring with state-of-the-art manufacturing facilities. All that is likely to push productivity growth higher. We already had a really good year last year for productivity growth. It accounted for a good amount of our real GDP growth. And I think that's going to continue to be the case. So I think the big story is productivity is going to grow. Technology is going to enable that. It's not just AI. And in that scenario, I see the stock market continuing to go higher, even if AI turns out to be somewhat disappointing in terms of relative to expectations, because the expectations are awfully high right now.
And let's talk a little bit more about your expectations, not only through year end. We also talked about your target, S&P target by the end of 2026, getting all the way to 6,500, I believe. In terms of those catalysts here, you mentioned productivity, that's improving. What else do you see in terms of leading the market higher over the next 2 years?
Well, I think it's fairly clear right now, anyways, that the U.S. economy is doing a lot better than most other economies. China's economy is likely to remain depressed for the next few years. We have a precedent of property bubbles in Japan, property bubbles in the United States. Property bubbles take 5 to 7 years before you really come out of the depressing impact that they have on your economy. So China looks like it's going to be depressed, but the good news for us is that means they will continue to export deflation, which will keep our inflation rate down, at least on the good side. We have Europe in a shallow recession, and it's got some structural problems. Germany's deindustrializing because of competition from China. You've got India looking pretty good. The stock market's very, very elevated there, of course. But put it all together, and it looks like the U.S. is going to continue to be a outstanding market, literally outstanding, standing out from everybody else. And I think that's a big part of the story for me, and why I think the market can continue to move higher.
Are U.S. companies, from your purview here, are they well insulated enough then from some of the slowdown that you were mentioning that investors have to also keep tabs on internationally, and especially, as you noted, within China?
Yeah, that's a good point. I mean, the good news for us in terms of a slower global economy is it keeps commodity prices down, it keeps the price of oil down, it keeps inflation down. The bad news is that for our exports, the markets aren't going to grow as rapidly. But I think the U.S. economy is showing enough strength that the domestic economy will provide some offset to weakness in the global economy. And it's not as though the global economy is not going to grow. It's going to grow. And maybe the areas of growth like India, maybe Brazil, Indonesia, some other emerging economies will show more growth while China kind of stalls out here for a while.
Yeah, that's certainly going to be interesting to see how it plays out, especially if we think about companies like Nike, companies like Starbucks, Apple even. We're going to keep close tabs on that kind of greater China and Asia Pacific build out that they have as well. Ed, we got to leave things there on the day. We got to have you back and continue this conversation for sure. Here. Ed Yardeni, thanks so much for joining us.
Thank you.
Absolutely. We've got all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Let's take a look at another trending ticker that we're watching this morning. HSBC shares moving to the downside, off nearly 9% in early trading after taking a $3 billion hit to its operations in China, sending its quarterly profit down 80%. We're seeing that concern reflected in the early action here this morning when it comes to HSBC. So profit hit very hard. Also, their guidance is an issue here with investors. Unclear guidance. One of the concerns here amongst the sell side analysts in terms of what the future looks like for HSBC. And Brad, I think simply put, Jefferies calling it a messy set of results here for the company. Morgan Stanley saying that the lower than expected final dividend could weigh on the stock in the short term. We're seeing that concern reflected in the early market action here this morning. Again, shares off nearly 10%.
Yeah, reported revenue was down 11% to $13 billion. They said that due to the impact of the fourth quarter impairment relating to the sale of their retail banking operations in France, that also hit on some of the disposal losses relating to repositioning plus risk management activities there. But there was one thing that really struck my attention here within this report, and it's the fact that they're implementing what we've heard time and time again, more cost discipline, targeting cost growth of approximately 5% for 2024 compared to 2023 on a target basis, and that really kind of built into their business plan for this year. But growth and spending efficiency, two of the big terms here that continue to come up time and time again when you do have a quarter like this and a company trying to turn around narrative as well.
Yeah, certainly. All right, well, let's take a look at another mover here this morning, and that is SolarEdge. You have shares nosediving after fourth quarter sales and the company's outlook disappointed Wall Street. And we're not just talking about a normal nosedive. You're looking at losses of 15%. Yahoo Finance's Ines Ferre has more on that move. Ines.
Yeah, Shauna, SolarEdge on the earnings call talking about an abrupt slowdown and also an inventory backlog. We're taking a look at shares that are down 15% in our clean energy chart here. And this is after the company's guidance for the first quarter came in what one analyst called meaningfully below what street estimates were, with the company expecting revenue to come in anywhere between 175 to 215 million. Street's expecting 373 million for the quarter. You see the results for their fourth quarter right there. On the earnings call, management talking about that slowdown in Europe. Management said that in 2022 and beginning of 2023, they saw an unprecedented demand for their inverters. Now they're seeing unforeseen tapering demand. Also in the U.S., while the commercial market is growing because companies are going net zero, the residential market is slowing significantly. In fact, management saying that they don't see a significant changes in residential dynamics until the interest rates decline. And that is something that we have seen over and over when it comes to solar technology stocks, when it comes to green energy, renewable energy stocks. The higher for longer interest rates are really hammering this industry, guys.
All right, Ines, thanks so much for tracking that ticker here for us today. Certainly one of the top trending tickers that we've been tracking on the Yahoo Finance platform. Appreciate it.
Thank you.
And shifting to a top trending story today, Fubo TV filing a lawsuit to block the sports streaming venture between Warner Brothers Discovery, Fox, and Disney's ESPN. Fubo TV saying in a statement that this joint venture will, quote, destroy competition and inflate prices for consumers. They go on to say and claim that the defendants have restricted Fubo from offering compelling streaming products that consumers would find desirable, despite similar products being offered by other traditional pay TV and streaming services, including the defendant's own Hulu service as well here as part of this challenge to the deal moving forward.
Yeah, certainly. They talk about the fact that they're being charged above market prices, saying that the creation of this new sports streaming service is going to ultimately increase some of those incentives not to make their content available to Fubo and others, putting them at a massive disadvantage when it comes to the broader competition within this space. And despite all this caught my attention. Michael Pachter over at Wedbush reiterating his outperform rating on the stock this morning, $5 price target. Just reached out to him to see if he could give us a little bit more info just in terms of why he still sees some upside. This stock has been under pressure, trading right around $2 a share. I believe lots of questions just about what the future looks like for Fubo TV, especially given the fact that competition continues to increase, the fact that a bundling service could potentially make it harder for a name like Fubo TV to compete and withhold and maintain their subscribers that they have within this space already. So we're going to talk in a little bit more more about that in the next hour, too.
Yeah, that's right. You mentioned the number of subscribers as of the end of, and we're still waiting to get, of course, that 10K for 2023, but building on top of what they had seen in 2022 with that 1.445 million subscribers in North America, 420,000 in the rest of the world. It really is just this sports realm that continues to get battled for right now. As they note within this, in 2023, 97 of the top 100 broadcasts, that was all sports dominated at the end of the day. So that's really why we're seeing so much of this proliferation in, or the move forward in this battle for the field, battle for the courts, and ultimately this might end up in the courts, especially given what we've heard already from the inclination from the DOJ to potentially look at this deal. In the next hour, we're going to be speaking with Fubo TV CEO David Gandler for more on the company's lawsuit to block the sports streaming venture between Warner Brothers Discovery, Fox, and Disney's ESPN. Coming up, casinos roll the dice here. Beat the house in 2023 with record revenue. Wait, they are the house. But can the win translate to wins for their shareholders? For more on this, we've got your full conversation after the break. U.S. casinos experienced a wave of wagers in 2023. Commercial gaming revenue for the year reached a record $66.5 billion, surpassing the prior record set in 2022 by 10%. So, how can casinos translate what was a record year for revenue into shareholder returns? For more on this, we turn to John Decree, who is the CBRE Capital Advisors Head of Research and Director of Global Gaming. Great to have you here with us on this topic. Let's start right there. After a year that we did see with the amount of wagers that were handled for casinos, how can they make sure that investors reap the benefits as well?
Yeah, I think that's the million-dollar question in the boardroom with the results that we've seen this past year and the trajectory of wagers and earnings of all these casino companies. We're generally surprised at how the stocks have performed. I think people have been anticipating a recession for the past 18 months, and it hasn't really come yet. So, we've seen companies starting to buy back stock in droves. MGM and Boyd Gaming are two that have been buying back a lot of stock and have seen strong share price performance on a relative basis. But the year ahead, I think companies just need to execute. The demand is there. They're managing some wage inflation, cost inflation. But these are free cash flow stories. They're value equities largely across the board in a market that's looking for growth. So I think casino companies will have to look for growth on top of what's been a record year. And in the interim, maintain discipline and use that free cash flow, and buying back stock seems to be one of the preferred methods for companies to create some value right now.
John, you mentioned one of the headwinds facing the industry is wage inflation, cost inflation right now. In terms of what that means or how you see that impacting, we know how it has impacted the bottom line over the last couple of quarters, but what that means here looking out for the rest of 2024, how big of a challenge is that for the industry at large?
Yeah, it feels like probably the largest annual increase in operating expenses for casino companies that we've seen in a long time. Wages is certainly a big piece of that. And after a couple record years of profits, things are catching up, like employee wages. There's pretty significant renegotiated union contracts that came this year, particularly in Las Vegas. And so it is a headwind. I think we're looking at mid-single-digit OPEX growth for casino companies broadly this year, and maintaining mid-single-digit revenue growth off the high base that you've mentioned, Brad, is going to be pretty challenging. So, I think they'll continue to find ways to mitigate costs in other places, and keep driving revenue. So they'll have to find new ways. They do have digital forms of gaming now. Sports betting has been a big boon for the industry, iGaming as well. And, that's a key area of growth that a lot of casino companies are participating in, like Caesars and MGM. And that's a growth source that'll help offset, some of the stagnation they might have in core earnings from all of that operating expense growth.
We're going to come back to that digital gaming side in a second here, but just staying on the physical properties that they operate as well. Are casino resorts recession-proof as the leisure makeup that we've seen in the experience economy decelerates from some of the revenge travel rebound that we had been tracking?
It's a great question. It gets tested and debated quite a bit. I think the term I like to use is recession resilient. And we kind of break it into two groups. Your regional casinos, which are frequently visited by customers a couple times a week or a couple times a month, and they tend to be quite recession resilient. Las Vegas obviously had a challenge during the great financial crisis. That was a mix of very low demand and significant supply growth, but we've seen Las Vegas evolve substantially since then. We've got professional sports teams and huge entertainment drivers, as well as group and corporate drivers to Las Vegas. So we're confident that the diversity of Las Vegas Strip business is going to help them continue to be resilient. Supply growth is very moderate. So, we think these businesses hold up very well in a recession. Obviously, every recession is quite a bit different, but so far, demand has been good across the board. It's been outstanding in Las Vegas. It's been stable in the regional markets, and absent the operating expense inflation that we've talked about, these companies continue to perform very well.
And Jan, just lastly, while we have you here, top pick on the property management side there that you got for some of the casino operators, and top pick as well on the digital. I said we'd come back to that.
Sure. Yeah, I think Caesars is our top pick, and they give you a little bit of everything. They've got a budding sports betting and iGaming business to go with their casino portfolio, land-based portfolio that's undervalued right now. They're doing very well, and we see the most upside in that stock. And then on the digital side, we like Flutter. They just listed in the U.S. They share a listing in London. They operate the FanDuel brand, which is the leader in OSB and iGaming right now. And on a relative basis, given their size and scale, I think they're relatively cheap compared to some of the other competitors in the space. So we like Flutter on the digital side.
All right, John DeCree, great to have you here. Thanks so much for breaking that down. Some of the plays that you still see as an opportunity despite the slowing economic growth that we are experiencing. All right, John, thanks so much for that. Okay, right here on Yahoo Finance, much more ahead. Toll Brothers are raising its guidance on, quote, a strong start to the spring housing season. So is the worst for the housing market behind us? We've got that and what it means for home builders next.
Welcome back. I'm Brad Smith alongside Shauna Smith. We're about 30 minutes into the trading day. Let's take a look at how things are shaping up right now. Stocks are moving to the downside this morning. Investors, they look to the Fed's January meeting minutes. Those are out at 2 p.m. Eastern time today. They're going to determine the timing of the central bank's rate cuts, perhaps in some of that tone and tenor that actually took place in the meeting. Investors are also going to be watching later on today for Nvidia's highly anticipated earnings that's coming after the bell.
All right, let's take a look at some of those individual movers on Yahoo Finance. Shares of chipmaker Analog Devices up slightly after beating earnings expectations on both the top and bottom lines in its fiscal first quarter. Now, the company did see revenue and gross margins fall amid some weaker sales, and it did provide a disappointing outlook for its second quarter. Despite all that, still looking at gains of about 0.5%.
We're also watching Wendy's this morning. Shares are pretty flat after the fast food chain was downgraded at JP Morgan from overweights to neutral. JP Morgan analysts also reducing its price target on Wendy's from $22 to $19. JP Morgan believes that shares will likely remain, quote, range bound in the near term.
Shares of Wingstop slipping after issuing an outlook that is just in line with expectations. Not enough to impress the street. The chicken wing chain is saying that it did see solid sales growth in the fourth quarter, especially in its digital sales. Another CEO calling 2023 its strongest year on record. They were able to do that despite the fact that so many consumers have been pulling back on their spending, only or really more so favoring some of those consumer staple plays, the necessities that they did need. But some of these restaurant chains, Wingstop, I guess, among them, just in terms of the demand that they have seen over the last couple of quarters, able to navigate what has been certainly a challenging time here for the industry.
Yeah, over the 52-week period, it was interesting. System-wide sales actually up by about 27%, 255 net new openings during the fiscal year as well. And then you saw the restaurant count increase system-wide by about 13% to 2,200 worldwide locations, just a little bit over that. The company's still going to have to try and make itself off of that viral do not take on a first date list, and it's doing its best to do that. I've been tracking their social media efforts there. So keep trying, and we'll see if that actually comes to fruition here. Digital sales, though, that increased actually for the quarter by about 67%, to 67% of system-wide sales. So digital doing well for the company right now. All right, well, Toll Brothers, let's talk a little bit about homes. Everybody, Toll Brothers showing positive early signs for this year's housing market, raising its guidance after home deliveries rose 6% from a year ago. This comes after mortgage rates ticked up last week, according to data from Freddie Mac, hitting the highest level in 2 months. For more on the state of home builders, we're joined by John Lovallo, who is the UBS U.S. Home Builders and Building Products Equity Research Analyst there. Whew. John, thanks so much for taking the time here today. First and foremost, let's just dive into these earnings from Toll Brothers, because if we're trying to get a read on the rebound efforts that we're trying to see within the housing economy, what is the read-through that we get from Toll Brothers here? On the super luxury side, I might add.
Sure. Hey, Brad, thanks for having me. I think the read-through is much broader than just the super luxury. Toll's done a very good job of mixing their portfolio down to basically cover most price points across the spectrum. I think the read is very positive. Order growth was up 40% year over year. Gross margin was well ahead of expectations by 90 basis points, and EPS beat meaningfully. And on top of that, they took their outlook up for deliveries, margins, EPS, and EPS actually went up by 10%. And so what does this tell us? I think it says that demand for housing remains resilient, right? And I think Shauna at the onset had mentioned, is the worst over for this market? And you look, I think it's been a tale of two markets. The new home market has been very good, and we can talk about that. It's the existing home market, because there's no supply of inventory on the ground, which has been much more sort of locked in place, if you will.
Right, John, that's great to point out, and I totally agree with you. When we talk about, though, I think one of the things, obviously, and I know you've covered it extensively, has just been the inability or lack thereof to meet that strong demand, right? People who own homes right now, many of them locked in the 4%, 5% below mortgage rates, they're simply not moving. Because of that, we have this massive disconnect between inventory and what we're seeing demand-wise. Are home builders, I guess, do you see them at all closing that gap this year? And what does the incentive picture looks like as they're trying to draw more people off the sidelines and be able to purchase their homes?
Yeah, it's a great question. Look, I think I would tell you at the onset that we would prefer lower rates any day over higher rates. It's better for the market. It's better for the stocks. However, what I would tell you is that in this sort of high 6, low 7% mortgage range, it's sort of Goldilocks for the home builders, because they have the ability to buy down mortgage rates and offer this financing that can allow folks to get into homes. And you couple that with the fact that people who own homes today, as you mentioned, Shauna, are not moving. They're kind of locked into place. And so the demand that is out there, and it is resilient, is all being funneled toward this new construction market, and the public builders are gaining a tremendous amount of share, though. So for the public builders that we cover, this is a pretty good environment.
How well are the home builders doing from what you've monitored at attracting those first-time home buyers, especially the millennial cohort?
Doing incredibly well, Brad. Look, this was a big concern for a number of years, that this generation was different. They didn't want to buy homes. They didn't want to own big, ticket items. Look, I think that as life goes on and life events like marriage and child rearing occur, we're finding that this generation is very similar to prior generations, and they want to own a home. And
of course we want to own a home, John. My goodness. Are you kidding me? I don't know. It must have been the great financial crisis, or just the wild inflation around student tuition. I don't know. Just throwing things out there.
Yeah. Yep. So the builders have done a very good job of getting out there, building smaller footprints, more affordable price points, maybe a little further away from city centers, but making the math work for this buyer.
John, when it comes to those incentives, circling back to what you just said a minute ago, I think the question out there is how long are these home builders going to leave some of those incentives in place? If you were to be, or if one of these home builders were to be the first to remove an incentive, how big of a hit they could potentially see as a result of that. How do you see the whole incentive game playing out here over the next couple of years?
I think it's important to keep in mind that home builders are underwriting or penciling these deals to a return, right? And so the toggle point is sort of gross margin. And so what they'll do is they'll go into the market, kind of gauge demand. If demand is good, they can raise prices to some extent. If it's not, they will offer these incentives. I think as we move into the spring selling season, at least here in the early days, there's going to be a reluctance to pull back on incentives because they want to get their footing in this all-important spring selling season. Now, as we progress over the next month or two, if that demand remains resilient, and by the way, Toll said that January and February were better than normal seasonality for them. In fact, very, very strong months. If that continues, I think you will see the opportunity for builders to pull back on the incentives, and that will be accretive to margins and frankly, to returns at the end of the day.
John, who's your top pick among the home builders going into the spring selling season?
Our top pick is still D.R. Horton. That's ticker DHI. We think that they're the largest by volume by a margin of, call it 15%. There's a lot of advantages to size and scale, both locally and nationally, and they attract the right part of the market, in our opinion, which is that first-time entry-level buyer, which is really sort of driving the demand in today's home building market.
John Lovallo, always great to talk to you. Thanks so much for joining us here on the results from Toll Brothers. Also what we're seeing play out more broadly within the home building space. John, thanks so much.
My pleasure. Thank you.
Well, coming up, traders are awaiting minutes from the Federal Reserve's January meeting that's going to be released at 2 p.m. today. We will discuss what this could possibly signal about the Fed's rate cut timing when we come back.
Treasuries ticking slightly lower ahead of the Fed's release of its January meeting minutes. Investors are hoping for more hints about the trajectory of interest rate cuts. The recent hotter than expected inflation report seemed to be convincing traders that the central bank could cut rates in June, according to the CME Fed Watch tool. For more on the bond market's reaction to the looming Fed minutes, we're joined by Kathy Jones, Charles Schwab Chief Fixed Income Strategist. Great to have you here with us. So, based on what we see in the minutes, where could we see the most movement in the bond landscape?
Yeah, hi, Brad. Thanks for having me on. Well, I think that the biggest move would probably come at the shorter end of the curve, because that's where the great uncertainty is. Will the Fed start cutting in May or June? Will they delay longer? How fast will they go? Those are all the questions that the market's dealing with. And we've had so much volatility in sort of the 1 to 3 year area of the curve. So I think that that'll continue to be the case until we get some really solid information. And frankly, I don't think the Fed is necessarily certain itself exactly where they plan to go. Our view is that they start to cut in May or June, go 25 basis points at the next 3 or 4 meetings, and see how things go. But that is predicated on the idea that inflation continues to come down and the economy moderates its growth rate somewhat.
Kathy, obviously this is not going to be included within the minutes, but the 2 inflation prints that we got last week, do you see that at all changing the calculus or the timing here, or maybe making the Fed a little bit more nervous and likely to stay with this wait and see approach now for maybe longer than it had initially anticipated?
My guess is that those that were nervous before got a little more nervous with those numbers. Those that weren't nervous before probably are shrugging them off and saying, first of all, CPI, it's not the PCE that the Fed uses as its benchmark. And secondly, 1 month doesn't make a trend. So I think it really depends on who at the Fed you're talking about. And that leaves us in this limbo, because we know there are a couple of holdouts, there are a couple of members of the Fed who really want to delay this process and are not certain that it's time to cut rates anytime soon. But that's probably a pretty small number, 1 or 2. And then you have the rest who are saying, we think we're set, we're ready to go. We just need a little more information for confirmation. So I think it's a push-pull from here, but we do need some good numbers to kick off the process. But I do hope that when we get the minutes this afternoon, we'll get some information as to what the holdouts are holding out for.
Yeah, and it's interesting, Kathy, we got some commentary and we're getting some more this morning, but there has been disagreement just in terms of what that last mile is going to look like in terms of the fight to tame inflation, how difficult it is going to be. I guess, what is your expectation there in terms of ultimately getting to that 2%? We're likely far off from that, and the Fed is going to act most likely before we get to that 2% level. But what do you think that last mile of the fight to tame inflation is going to look like?
I haven't been in the camp that I've worried that the last mile is going to be so much more difficult than the previous miles. We've got momentum. We're hearing from businesses that pricing power has come down, that they're seeing, certainly in some areas of the consumer sector, they're seeing people dial back a bit in terms of purchases and resist some of the price increases. At the wholesale level, we're looking at commodity prices still low and coming down. So all the indications are that inflation will continue to moderate. We have the rent issue, that owner's equivalent rent issue that's in front of us still, are continuing to kind of support inflation when you read some of the indices. But we also know in real life that rents are coming down. So I'm not in the camp that worries too much about the last mile being the hardest. And I think that the question gets to be what will convince the Fed that it's time to start reducing rates, because real rates are very, very high right now. And if they sit still and inflation does moderate further, that's just pushing up those real rates even further and risking triggering some sort of negative reaction in the economy.
I mean, consumer confidence right now, based on the most recent reading, Kathy, we know still sits at a 2-year high on the index on views of the current conditions, plus some declining pessimism here. And particularly what Dana Peterson at the Conference Board had mentioned was the increase in consumer confidence reflecting slower inflation and anticipation of lower rates ahead. How does the Fed ensure that with a confidence print like this, an environment, that they don't see a spike the second they begin cutting rates because the consumer is already anticipating it so much.
Well, so consumers are anticipating lower inflation and continuing to keep their jobs. You know, consumer sentiment usually is pretty strong, particularly the coincident indicators when people have jobs, and people have jobs. And that's why spending has held up reasonably well. So I don't think the Fed needs to worry about a spike in activity just because they cut rates. They might see the housing market pick up, which would be welcome, I think, after the long sort of slow frozen period that we've had. But I don't think unless we're starting to see wage growth just spike higher because of a shortage of workers, I doubt that the Fed's going to worry that this is going to trigger a big inflationary reaction.
Certainly. And then just lastly for investors here to round out this conversation, Kathy, if we do see less cuts than anticipated over the course of this year, is there a massive repositioning that some fixed income portfolios out there should be considering?
At this stage of the game, the market is priced for about 4 rate cuts of 25 basis points each between now and the end of the year. We think that's a pretty reasonable expectation. If we only get 2, then we're going to see quite a bit of volatility probably at the short end and a more of an inversion of the yield curve, because the tighter the Fed is for longer, the more that sends a signal of slower growth and less inflation down the road. So our base case is we get 3 to 4 rate cuts, 25 basis points each between now and year end, and that yield curve kind of steepens a bit from here with short rates coming down more than long rates. But if the Fed drags its feet, then it could go the other way and we'd see more inversion of the yield curve.
Kathy Jones, Charles Schwab, Chief Fixed Income Strategist. Thanks so much for taking the time here today. Appreciate it.
Thank you.
Coming up, former President Donald Trump just keeps taking L's. We'll dive into the trail of losses following Trump in the run-up to the 2024 election. That's next.
Former President Donald Trump is on the hook for over $350 million following his New York civil fraud case. And just last month, a federal jury found Trump guilty of defaming E. Jean Carroll, a judgment that will cost him another $83 million. Here to break it all down and what the string of losses means for former President Trump, we want to bring Yahoo Finance reporter Rick Newman. Rick, he's being held accountable. Does it matter, though, with his base?
Yeah, it doesn't matter to the base, but I think it matters for the rest of us. Everybody remembers when Trump said, I think he said this in 2015, I could shoot somebody on Fifth Avenue and I would not suffer any consequences. The important thing to notice here is Trump is suffering consequences, politically, legally, and in terms of his business. So, I just put together all the things that have gone wrong since he had this surprise victory and he won the presidency in 2016. Just to string them together. 2018, huge win for Democrats flipping the House. Record turnout for people voting against Trump. Trump loses the presidential election in 2020. He basically lost the Senate for Republicans by turning people against the two Republican candidates down there. He was a negative factor for Republicans in the 2022 midterm elections. And he's now lost three important court cases. Last year, or late 2022, his company lost a case. Then he lost the defamation case against Jean Carroll, and now he just lost this civil fraud case. He's facing, like $500 million in penalties. And I keep hearing, I point this out in a story, and I keep hearing from Trump supporters, oh, but these are they're all going to get overturned on appeal. But these are the same people who said this case would get thrown out of court in the first place. Then he would win these cases, and now they're saying it's going to get thrown on appeal. Trump is a loser. Now, I don't know what's going to happen in 2024. He could win in 24, but everybody remembers Trump said so much winning. Well, it's a lot of losing.
Have these losses actually showed up in the polls thus far? Do we know?
I think they have. First of all, remember, Trump lost in 2020, so that was the biggest poll of all.
Right.
There's this big discrepancy because he obviously is dominating the Republican Party, but he seems to be less popular than he was among the general public in 2020 because we've now had the 2021 riots at the U.S. Capitol and all these legal cases and lawsuits against him, which are still piling up. And we haven't even gotten to any of the 4 criminal lawsuits he's facing.
Right.
So, there's a really important thing that pops up in polls, which is there are some people who say, I generally support Trump, but if he were to be convicted of a crime, I might not support him. And it does look like we're going to have at least one of these cases that's going to happen in New York City starting in late March. So it looks like we will have at least one outcome in one of these criminal cases. Now, obviously, he's running against Joe Biden, who is also a weak candidate. So this does not mean Trump is doomed in the 2024 election. But man, is he vulnerable.
Well, according to some sneakerheads out there, he should be convicted of a crime for putting out the T-Red Wave gold sneaker that he tried to take to a sneaker convention in Philadelphia.
You seem like you take personal offense.
Rick, thanks so much for joining us here on set.
The resident sneakerhead.
We all have shoes. All eyes are on NVIDIA as it gears up to report earnings after the bell. Here's a look at what this could mean for the markets.
Nvidia is moving markets like it's the Federal Reserve. That's because we're about to get their fourth quarter earnings, the most anticipated company results so far this year. The chip giant's earnings could be a make or break moment for markets, which pulled back after hotter than expected inflation data. That's only furthering hopes that Nvidia could turn things around. So can they? Well, the bar is really high. The stock is up about 47% this year, which made Nvidia surpass both Amazon and Alphabet in market cap. And this comes after Nvidia rallied by over 200% in 2023. All that rallying means Nvidia has gotten pricey. If forward guidance doesn't justify the company's valuation, the AI-powered Nvidia balloon could pop. One Bank of America analyst said while any post-earnings moves from Nvidia would be notable, they'd also be brief. Now that could be due to the company's revenue, which is expected to triple this quarter to over $20 billion. Now for context, the company's full-year revenue in 2023 was $27 billion.
The increase primarily due to data center revenue, which accounts for about 80% of Nvidia's sales. Wedbush analysts are zeroing in on those data center sales, which they expect to deliver good news this week. Regardless of the outcome, investors seem to agree on one thing: it will be market moving.
It's been a few years since COVID upended the global travel sector. The world is now largely vaccinated, the recession we were all hoping to avoid didn't happen, and the consumer is still spending. Oh, and the Fed is about to cut rates, so looks like we're poised for another huge year. Well, maybe. But there are more than a few headwinds to contend with, not to mention trends that could reshape the way that you think about your next vacation. Is Delta the airline best positioned to hold market share? Are cruise lines about to hike prices on a stream of never-ending demand? Is astrotourism really the next big hit for 2024? And should you really drive your Tesla from LA to San Francisco? Yahoo Finance's Travel Guide 2024 Industry Insights puts you at the center of the story, looking at planes, trains, automobiles, and any other form of transport you can think of.
Big Food is trying to get back into the good graces of investors who have soured on the space as the Ozempic craze takes further hold. Not helping sentiment on the industry is that food inflation remains sticky.
causing consumers to pull back on discretionary spending. Let's check in with one of the brighter spots from within the big food space. Oreo and Cadbury maker Mondelez. Here with us now is Mondelez Chairman and CEO Dirk Van de Put. Dirk, always nice to get some time with you. So really, I think your presentation down at CAGNY was well received. Lots of focus on the top line, and that is a little bit also the vibe at the CAGNY conference. What are you doing to get your top line growth rates to the next level this year?
Well, first of all, thanks for having me, Brian. It's always a pleasure to be here. I would say that for us, a continuous investment in our brands and not trying to drive the bottom line at any cost, but always reinvesting half of the extra margin we grow every year into our brands has proven to be a very good recipe for us. So that's for sure something that we will continue to do going forward. We've done it in the last 5 years. It has worked well.
The last time
go ahead.
Last time we talked, Dirk, you put a lot of emphasis, and I think it was Milken last year, a lot of emphasis on the Oreo brand and how big that brand has gotten in terms of importance for your company, in terms of sales, in terms of profits. How do you unlock further growth in a big growth driver like that?
Well, the two biggest markets for Oreo are the US and China. And there, the brand has over 10% market share in the biscuits market. There's no other country in the world where Oreo has that type of a market share, but it's a yardstick. It's where we can get. So there is this geographical opportunity in all the other countries in the world to bring Oreo to the same level as the US and China. And then in the US and China, it's about keeping the brand active. If I look at Oreo, the penetration per year is quite high in the US, but there is still opportunity, and it's only once a year. So we can increase what we call the frequency of consumption many, many more times than we have today. So even in the US and China, there's a huge opportunity for us by just getting consumers, irregular consumers, to be more regular consumers. And then I would say to keep the brand alive and to make sure that it really connects, we try to link it to the actuality of the moment anywhere in the world. So we were in the Super Bowl with our spot. There's big things coming in the second half. We've done Pac-Man. We've done Lady Gaga. So we keep the brand active, and that attracts consumers. They want to have the special edition related to that. And we have a whole pipeline of things we can do with the brand. So keeping it top of mind of consumers, driving the penetration and driving the frequency, I think the runway for Oreo is really big for the future.
One of my interpretations, Dirk, from the presentation was that Mondelez is ramping up efforts to make a larger push at U.S. convenience stores. What does that exactly look like, and how large is that sales opportunity?
Oh, it's well over $1 billion or more for us. As a company, we are very well represented in the grocery stores. That's our strength. Where we're not so well represented is in convenience store. Yes, of course, you will find Oreo, you will find Ritz, you will find Cliff Bar, but it's a bit fragmented. It's not the nice, solid presence that you would expect. And so we have a real opportunity there. And so for us to get organized, to really work on the route to market, our in-store presence represents a really big opportunity for us in the U.S.
Consumers have really, and we saw a little bit of this yesterday in Walmart's earnings, consumers appear to be pushing back on a lot of the price increases that were taken during the pandemic from a lot of food manufacturers. What do you just say to consumers that are tired of these price increases, and are you seeing costs come down for your business?
I'll start with the last part. Unfortunately, we don't. I know it has to happen at a certain stage, and what is annoying for us is that whatever the increases were 2 years ago and last year, those costs, it was transportation or it was packaging or it was some of the oils we use, they're not increasing anymore, and some of it is coming down. But this year, cocoa, sugar, and hazelnuts are really going up in a quite significant way. So it obliges us, again, to do price increases. We would prefer not to, but unfortunately, the inflation on the cost side for us is not stopping. What I would tell consumers is that it's an affordable indulgence or an affordable luxury. It's time for yourself. It's not a big spending. It's something you can do on a day-to-day basis, and that's what we see from consumers. We've had to increase our prices in the last 2 years quite significantly, but we saw almost no elasticity. consumers want their Oreo, they want their Ritz, they want their Cliff Bar, and so I would say I hope that the consumers will stick with our brands for another round of prices. It's not that big in the US because it's largely the chocolate brands, Milka, Cadbury, that are affected this year because of the cocoa prices. So the price increases in biscuits are very limited. So I hope the consumer will understand that and be loyal to our brands, which so far they've done. So I feel pretty confident about that.
One of your competitors in the chocolate category, Hershey, yesterday talked about double-digit price increases because, to your point, cocoa prices they've gone through the roof. Are you looking at similar increases?
Yes. We are not very represented in the chocolate market in the US. The US consumer will not necessarily see that in our brands. But in Europe, where we have Milka and Cadbury and so on, yes, we are looking at the same double-digit price increases in chocolate.
Under your leadership, Dirk, you really have repositioned or reinvented Mondelez, a Cliff Bar acquisition, a series of acquisitions. You have I think a lot of folks on the street commend you for the work you've done there and also improving your balance sheet, a lot of cash. Are you open to doing another deal this year? And what's your sense on the valuations on some snack brands?
Yeah, yes, we are open. M&A, well thought through, financially disciplined M&A is part of our equation. It has worked well for us. I think we're good at it, but we won't do it at any cost or at any price. It's not like we have to. We have very solid organic growth as a company, and we can make the company outgrow, I think, most of our competitors just in an organic way. But M&A helps because it fills the gaps that we have around the world. What I'm seeing is there is certainly more interest in deals. Valuations are not coming down because there is more interest. The expectations of valuations are going up. But with the higher interest rates and the slower growth, it's much more difficult to get a return on your acquisition. So we don't want to do crazy things. We are, like I said, we're disciplined. If it financially doesn't make sense to us, we won't make the deal. But there will be opportunities, and yes, we are working on potentially more deals this year, but I cannot tell you if they will come through, yes or no, at this stage.
Before I let you go, you teased some more big potential partnerships. Anything in the works with Taylor Swift? That's a standard question now, Dirk. We have to ask all companies if they're working with her.
I cannot say anything until it's signed, so I have to stay mute on the subject. But there is some very interesting stuff coming up on Oreo. I can tell you that.
All right, fair enough. Thank you for always making time for us, Dirk Van de Put, Mondelez Chairman and CEO. We'll talk to you soon.
Thank you.
We're looking at Beyond Meat shares down almost 60% in the last year. This comes as sales have fallen, expected to be down over 17% in its latest quarter. The alternative meats category sales are down over 33% from a year ago, according to recent data from Circana. Now, Beyond Meat is introducing a new product line today, and could it be the company's saving grace? Our very own Brian Sazi here with the inside scoop or bite on this one. Sazi, you spoke to Beyond CEO. What did he have to say, and is new meat going to save Beyond Meat?
You guys are really putting me to work today, Brad, from chocolate to plant-based meat. So very interesting chat with Ethan Brown over at Beyond Meat, making a big change on how their products are made, removing things like canola oil and coconut oil and moving to avocado oil. Sounds like a small change on paper, but it's not. What this essentially does, and I have the bigger story on this on the Yahoo Finance homepage now, it is reducing fat counts and improving sodium, or just lessening sodium count in the products. Now, these have been some of the highest, I think, really the area where critics have really hammered Beyond Meat and Impossible Foods and everybody that makes plant-based food because they don't necessarily have maybe the best or most robust nutritional aspects. So again, Beyond Meat pulling back on some of these higher fat ingredients, also reducing its ingredient list or the number of ingredients which Ethan tells me should help improve the profitability of these items, like you see on the screen. That is in fact the new ground beef, and you see it there. First time getting the American Heart Association award. But guys, as you mentioned coming into this is a stock that has been really through the ringer. It came out of the gate, really robust IPO several years ago. It hit a high, I think, of $234.90, and how it's really crashed back down to earth. You have Impossible Foods delayed their IPO. And I think what Ethan is trying to get the point across is that this could be a reset moment for Beyond Meat and other companies. but I think the market needs to see this. Beyond Meat's going to report earnings next week, February 27th, and this could be another challenging quarter of sales down double digits and another loss. I believe the street is expecting Beyond Meat to lose 88 cents a share based on Yahoo Finance data on our site.
It says, what do you think the street wants to see from Beyond Meat? Because like you just said, and like you pointed out in your story, it certainly seems to be a reset moment for the company. They're doing everything they can to lure back some of the consumers that they lost. They're doing everything they can to win the trust and belief here from investors. Is more, though, needed, do you think, in order to get people back on board?
I think Beyond Meat thinks this is the starting point of getting to stabilization. So I'm not going to sit here and say this one ground beef product, this one patty product is going to reignite sales growth for Beyond Meat overnight. I think the street would just like to see stabilization, in part because of a product like this. Get this product to restaurant partners. This product will just launch at retail partners initially in the spring. And then maybe in the back half of this year, Beyond Meat returns to low single-digit to high single-digit percentage sales growth and maybe turns a profit after reducing a large part of their workforce. But again, this remains a show-me story in Beyond Meat. And I think a lot of folks next week, I'll quickly add, when Beyond Meat reports, really keyed in on their balance sheet. Company ended the third quarter about $217 million in cash. They have some debt coming due in a couple years. I think the street wants to see profits start to flow, the balance sheet improving so they can meet those debt obligations and get to a brighter day.
Well, something that a lot of the customers are going to want to see and perhaps are getting here, 20% less sodium than the previous version. That was a big hang up.
It's a good thing.
Yeah.
We don't need more salt. I'm not getting any younger, Brad.
I mean, that was the hang up for the American Heart Association last time.
I'm not trying to go in the grave.
No.
Yet.
No, not. Sazi, thanks so much for joining us here today, discussing all things foods. Brian Sazi here with us on set. Guys, coming up, Fubo TV suing ESPN, Fox, and Warner Brothers Discovery after and over its joint venture sports streaming service. We're going to speak with the Fubo TV CEO, David Gandler, on the other side of the short break.
Fubo TV is going after Disney's ESPN, Warner Brothers Discovery, and Fox, alleging that the group's new venture is stifling competition. Now, in the antitrust lawsuit, Fubo TV called the new partnership a, quote, sports cartel that has blocked Fubo TV's playbook for many years and is, quote, effectively stealing it for themselves. Let's discuss that and more. We want to bring in David Gandler. He is the CEO of Fubo TV. David, it's great to see you. Thank you so much for taking the time to join us here on Yahoo Finance this morning.
Thank you for having me.
So let's talk about the suit that was filed yesterday after the bell. And you've alleged in this suit that even before this joint venture was announced, that you believe these companies have had a clear agenda that would be not advantageous to Fubo TV. What is that agenda?
Yeah, well, look, it's pretty simple. You're seeing the impact of Netflix on these businesses, their inability to compete. And so I think the way they look at us and have looked at us for years is basically, how do we marginalize this company to ensure that we don't find ourselves, several years from when we launched in a situation where we now have a Netflix of sports or, a more niche bundle that we have to deal with. And so they have utilized, pernicious MFNs to distort pricing. They forced us to bundle content in the hundreds of millions of dollars of cost to us that customers didn't really want. And then they come up with this brilliant idea of, hey, we want to attract customers that are not interested in this sort of larger bundle. So when you put all of that together and the aggressive fees that are grossly above market, actually, you end up having a service that has basically taxed customers a ridiculous amount of money over time. And so my view here is very simple, that there are significant monetary reparations in order here. And we will gladly return those to customers, anything that we're able to gain, in the form of, promotions and discounts going forward. So this is a real situation. It's anti-competitive. And all we ever wanted to do was to compete on equal terms. But that has been proven to be impossible.
David, when it comes to pricing, you quickly mentioned it there. I guess, how significantly do you see bundling tactics like this and eventually raising prices for the consumer?
Well, I mean, one of the worst things about this, and, again, I'm not a legal expert, but to me, this is almost borderline racketeering. Because what's happening in the industry is that the media companies are saying, look, if you want the full bundle, go get a pay TV subscription. And at the same time, they're taking certain pieces of content out of the bundle to force a consumer to get that one extra game or two extra games to pay for another service. So they're basically double paying in more than, I would say, 30 to 50% of cases for the same content. So it is, there's no way that prices will not continue to escalate. And I think one of the ideas is, if we have reduced the number of competitors in the space, we can basically run the table.
If we did see this deal go through and there was some type of moderation or outflow, because now you had consumers who were gravitating perhaps towards another service, what would that mean for Fubo TV specifically, as you think about the liquidity as you're funding the current operating plan that you had laid out to investors back in November?
Yeah, well, I'm glad you brought that up. I mean, this is not something new, right? You're talking about media companies that own their own, distribution. And as I said, they distort pricing to us. This is something that we've been dealing with for 9 years. And, if you look back historically, obviously I can't comment on the current quarter or 2023 full year. But what I will say is, looking backward, is that we have done a tremendous job in being very efficient. We've met or exceeded guidance, I would say, 13 or 12 to 13 times out of the last 14 or 15 quarters. We have improved. We've beat consensus 3 times on the bottom line. And, we're continuing to march down our path to achieve profitability regardless in 2025. So, but we shouldn't have to do it in such a way where they block us in every possible opportunity to grow our business. Frankly, there are significant damages here because we have not been able to compete fairly with the group of companies that they put us in, which is with Hulu. We've not been able to package the same way. We don't have access to ESPN Plus. And so, but we still believe that we're on track with respect to our 2025 plan, again, based off of the last quarter numbers that we provided in November.
David, just pushing back just a bit, because I think you could, or people out there could make the argument that, hey, this industry is more competitive than it had been a decade ago, 2 decades ago, when you have the entrance of many of these larger tech giants. They are now on the playing field there. What's your response to that argument, the fact that it's not just anymore about some of these legacy players?
But it is, because if you think about what they've done, they've weaponized an American institution, which is the NFL. You cannot, at least in my view, is they have these rights for the next, 8 to 9 years going into 2030. So when you control, 100% of the National Hockey League rights, national television rights, and 100%, at least as of today, the NBA, the national NBA rights, 50% of NFL and college football. You're basically, dealing with a group of companies that are controlling, for now at least, and for the foreseeable future, this industry, with a goal of colluding and ensuring that they maintain that type of control. What's interesting to me is, and I'm sure you would agree with this, is that no longer can they consider merging, because that obviously would be a non-starter for any DOJ to consider. So therefore, this is the next best option. Let's circumvent merging and just collude via this, I'll call it, because they haven't named it yet, so I'll name it for you guys, which is Sports Cartel TV, to really marginalize players like Fubo.
This feels like a reversion back to some of the cable bundles that we had known in the past, but on streaming grounds, and would love to know how consumers should perceive these partnerships that are moving forward.
Yeah, well, look, I mean, if you look back to my shareholder letter of 2021, I believe it's actually exactly maybe 3 years ago, I said we were going to move from bundling to unbundling to the eventual rebundling, of this content. We have conducted numerous surveys. We collect 2 billion data points a month. And basically what we found is that consumers, 3 out of 4 consumers prefer to watch content on an aggregated app versus a direct-to-consumer app. And I think these media companies are learning the hard way, tens of billions of dollars of losses that they are asking us to subsidize, that it doesn't work, and that the churn rates are too high, the marketing costs are too high, the tech costs are too high. And so the only way to do this is to really stomp out competition. And I think consumers should be very nervous about this, because I think historically we've seen this playbook, whether it's with email or with any other services. They start out either free or cheap, and very quickly, if you look at the compounded annual growth rates in terms of pricing for any services, you'll see how quickly they ramp up once they start to feel comfortable in a market. So this is very bad for customers. They should really be upset about this. They should be worried about it. And, we've set up a landing page, savemysports.com, really asking people to read the letter that we put out there to support free choice and competition, because ultimately it will benefit them.
Well, David Gandler, we appreciate you taking the time to join us here on Yahoo Finance this morning, CEO of Fubo TV. Thanks, David.
Thank you very much.
All right, let's do a quick check of the markets before we let you go. 90 minutes into the trading day ahead of Nvidia's big earnings report after the bell. And we're still looking at red across the board for the major averages. You've got the Nasdaq, the underperformer so far of this morning. You're looking at losses of just about 0.6%. Well, that does it for us today, but keep it right here. Rochelle and Nikifo have you for the next hour.
Welcome to Yahoo Finance Live. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo alongside Akiko Fujita. Here's what I'm watching this morning. All eyes, of course, on Nvidia as investors eagerly anticipate the chipmaker's fourth quarter earnings coming after the bell today. Nvidia, the last of the Magnificent Seven to report this earnings season, and the expectations couldn't be higher. But will this be a make or break moment for markets?
Well, the new era for streaming bundles hitting a bit of a speed bump. Fubo TV filing a lawsuit to block the ESPN, Fox, and Warner Brothers Discovery sports streaming venture. More ahead on what investors need to know.
And setting the record straight on your finances. Consumers may be miscalculating how buy now, pay later services impact their credit scores. We'll have the breakdown coming up this hour.
First, though, let's take a look at where markets are trading. We are 90 minutes, of course, into the trading day. And as Rochelle mentioned, some big earnings on tap today with that focus on Nvidia. Ahead of that, though, we are seeing all three majors in the red. The Dow down 84 points, the S&P 500 down 10, and the Nasdaq down 89. We are also expecting minutes from the Federal Reserve's January meeting later this afternoon. Of course, investors watching that one closely to see if there are any hints of when that rate cutting cycle may start. Let's take a look at where Treasury yields are, surely to move on the back of those minutes coming out as well. We are seeing them push higher today with the 10-year yield at 4.28% and the 30-year yield at 4.45%. Let's get, though, to today's top story, and that is Nvidia. Take a look at where the chipmaker is moving ahead of its fourth quarter earnings results. We've seen a bit of a push lower yesterday, today as well. The stock down about 1.9%. There is a lot of pressure on the company. Goldman Sachs calling it, quote, the most important stock on planet Earth. And Rochelle, of course, that's because of the weight the company holds or has held. When you look at where the gains have been, accounting for about a quarter of the S&P 500's gains so far this year. This is, of course, a bit of a bellwether for the AI industry. Questions about how much this momentum can continue. It's not just about a miss, but really just failure to impress investors that could potentially mean a bit of a sell-off and maybe a trickle effect into some other AI names as well.
Indeed. I mean, as we mentioned, a lot of pressure on this company, but CEO Jensen Huang really not playing down any of that. In fact, last month he was saying last year was the beginning. This year is going to be a huge year. And keep in mind, over the past year, Nvidia's stock up around 230%. And as you mentioned, expecting a stock to keep jumping, 50% month after month. Clearly not sustainable here, but I think one of the things they'll be looking at is what we're seeing with supply constraints. I think that might be something investors will probably hone in on because clearly the demand is there, but those supply constraints, depending on how deep they are and how long they last, that might play into perhaps some of the reaction that we may see later on in the stock. But as you mentioned, this is of course a proxy for AI demand. So this is a longer play. We are still at the very beginning of this, considering where we were a year ago speaking about generative AI, and now obviously it's everywhere. And then seeing some of the supporting cast that also feed into this, given Nvidia's dominant position when it comes to data center AI chips, these GPUs, then allow other companies to have that infrastructure to build out their own AI as well. So definitely the one to watch today, and has been in the works for a while in terms of the excitement leading up to this.
Yeah, and of course this comes at a time when we've seen that trade, the Magnificent Seven trade, kind of sort of see a bit of a divergence there. They haven't necessarily been moving in the same direction. Obviously, these companies have very different narratives as well, but you do have to wonder how much of that trade unravels if Nvidia does disappoint to the downside today when they report their results. And to your point, really, there isn't necessarily a question about whether, in fact, this AI demand can keep up. If you believe what every other company has said out there, there are questions about the valuation, how high this stock has run up, and whether, in fact, this is kind of the time to sell. You could argue a lot of investors are already moving in that direction when you think about where the stock has been moving ahead of these results.
It's true, and we'll be keeping an eye on some of those price targets. I believe the highest we've seen so far, 1,200. So we'll see what happens. Well, staying, of course, with Nvidia, the big story on the street today, as the stocks move post-earnings, tend to have a huge impact on broader markets. So here to show us what that usually looks like is our very own Jared Blickery. Now, this isn't a usual time we're in at the moment, so I appreciate you breaking this down for us.
You bet, Rochelle. Nvidia in no words, it's the dog that's wagging its own, or it's the tail that's wagging the entire market here. The S&P 500, the Nasdaq 100 just appear to be pyramided leverage bets on what Nvidia is about to do. And let me just give you a one-year chart so we can see the earnings reactions that we've had for the four prior reporting periods here. So this does go back 1 year. The last two times, that was actually a sell the news event, or at least don't expect the prices to go higher. In fact, 2 periods ago, we had a $499 high, and that was the high. That was the reaction day. That was the high for months. So not necessarily anything has to happen, but then when you take a look at what happened a few quarters before, you will see that in May, we had a fourth largest reaction. That is a fourth biggest market cap gain ever. And before that, it was kind of a non-event. So a mixed bag historically, but let me just show you some of the biggest market cap moves ever. And right there, number 4 is Nvidia, $184 billion on May 25th, 2023. But then number 1 only happened very recently. That was Groundhog's Day this year. Meta, $197 billion, almost $200 billion. So the moves are quite substantial here. And then Rochelle, you were talking about the price targets from analysts, the highest one, 1,200. Well, guess what? In the options market, we have the biggest number of options contracts. Biggest open interest is at 1,300, and that is the highest strike that is available for this issue. And it's kind of hard to see, but these blue lines here are calls, while the red one is put open interest. And you can see just how far this goes, how far the expectations are for Nvidia to potentially capitalize on this. Reason I'm making such a big deal is because with leverage, when things don't go the way people expect, these trades collapse very, very quickly. And I don't think it's a surprise that that's why we saw Nvidia having its worst day of the year yesterday and then kind of spilling over into the broader market.
Yeah, and broader concerns here, given just how crowded that tech trade has been. Jared, another big story in the markets today, the Dow replacing Walgreens with a little upstart known as Amazon. What can you tell us about what's going on there?
Well, let me take you back to August of 2020, and that was the last time the Dow had a major reshuffle, and some interesting things emerged from that. They kicked out ExxonMobil, and they added Salesforce. And what I've done here, I have shown the performance since then, since August 31st, 2020. Guess what? Exxon is up 164%, had an incredible couple of years. Meanwhile, Salesforce barely break even. They're a little bit to the downside. One of the trades that kind of worked out was Pfizer, although it was looking like a bad idea in the beginning. Pfizer down 22%. They wanted biotech, so they put in Amgen. Amgen up 20%. And then Honeywell replaced RTX. But look, RTX up about 50%. In hindsight, that may not have been the best move. Now, what's interesting is what kicked all of this off in August of 2020 was a stock split for Apple. Apple was a huge point gainer there, and we know in the Dow that it is not market cap weighted, it is point weighted, so the higher your stock price is, the more influence you have. And then when Apple cut, they decided they wanted more exposure, so they got Salesforce to join the ranks. And in hindsight, you never know what's going to happen going forward, but I think we have seen enough examples historically where you have these additions to the Dow and they kind of got egg on their face sometimes. And will this be another example? I don't think so. I think Amazon, much stronger company than Walgreens, but you never know here.
Okay, we'll see where that trade goes. Jared, thanks so much for breaking that down for us. It is time now for today's trending ticker. And today we're watching shares of Intuitive Machines. That stock down about 6% right now as the Texas-based aerospace firm inches closer to a lunar landing. Intuitive launched its lunar vehicle Odysseus on board a SpaceX rocket last week. It's hoping to become the first commercial company to successfully land on the moon. The firm saying they are now on track to hopefully stick that landing early tomorrow evening. Really cool, Rochelle. They tweeted out this photo of the moon about 662,000 miles out. And of course, this is the second attempt by an American commercial company to try and stick that lunar landing. Unfortunately, Astrobotic last month couldn't make that happen. But there's a long pipeline here of lunar landings or lunar landers that are looking to make that trip. Fingers crossed for Intuitive Machines.
It's true. And, there has been quite a run up in the stock ahead of this time. Some of it, I think a lot of people are excited about not just the moon landing potentially, but also, it's an exciting new frontier here, but then also a little bit of bearish sentiment, perhaps some short covering coming in at play. But I'm excited to see. I do hope they stick the landing. I mean, it's something, we don't see every day, and especially to see a commercial company coming into this space. Exciting stuff. Interesting to know where we're seeing the stock trading at, though, given that when it first had its
it was up 65% yesterday. So
exactly.
So I guess to be expected a bit of a sell-off there as well, Rochelle.
Indeed. So something to keep an eye on there, but high hopes, certainly. All right, well, do stay with us because coming up, we have a new survey from Boston Consulting Group showing cost management is the most important strategic priority for executives in 2024. We'll discuss what this signals about the state of the labor market next. Companies including Alphabet, Microsoft, and Amazon have announced job cuts so far this year, but the announcements aren't as abnormal as people may think. Amid the current economic recovery, monthly layoffs have bounced between 1.3 million to 1.8 million a month. Now that's higher than the average 1.6 million to 2 million a month that we saw pre-pandemic. For more on how this impacts businesses, we're joined by Rich Lesser, Boston Consulting Group Global Chair. Thank you for joining us this morning here. So give us some context in terms of where we are in terms of sort of that overcorrection from a lot of that pandemic hiring to some of the streamlining and the cost cutting that we're seeing now.
Right. It's important to put in context where companies are at right now. I think the starting point is not we're in a very difficult period. The economy has managed to pull out a soft landing. Most businesses see a moderate amount of growth ahead, but they see a moderate amount of growth, and they see a period of one shock after another. And I think as a result, there's a lot of focus this year, and that's what our survey showed, on cost management. But important to highlight is the cost management wasn't centered on cutting employees. The cost management is set on manufacturing, supply chain costs, looking through their value chains to find opportunities. So I think most companies, and you see it in the data you just shared, we're not in a period where people are heading toward extraordinary layoffs, not in any of the data we've gathered. We are in a period where people will be looking closely at their whole cost structures to see where they can do better.
Rich, on the issue of cost cutting, it really does feel like we're in a bit of a transition period where, on the one hand, companies are, to your point, looking for efficiency. A lot of that being driven by automation. Also, companies looking at investing in things like AI as they look ahead to the future. I wonder what those conversations are like within the C-suite. What are you hearing from clients about how they're sort of weighing all of that?
Right. So, look, let's start with where we are. The overall economy is on a reasonable track. It's not on a great track, but it's certainly not on the very negative track that people were talking about a year ago. And that's an encouraging sign. But in a slower growth environment, that means to perform well, you have to outperform. And to outperform, you need to drive higher productivity, and you need to reinvest some of that productivity to find above market growth, because market growth is unlikely to be sufficient. And I think in many sectors, that's the way CEOs are viewing it. This isn't about, do we cut cost or grow? It's, how do we get more productive and reduce cost where we can in order to fund the growth that we need to be able to outperform and to embed new technologies like AI, like automation, into the core of our business, which is going to be critical for long-term success.
And Rich, I thought it was very interesting in terms of the confidence that executives have in terms of their preparedness for shocks. Obviously, we've got a lot of global elections, including here in the US, ongoing geopolitical tensions as well. Why do they feel more prepared going into this year?
It's like an athlete who's been through multiple workouts, one after another. If you've been through COVID and supply chain shocks and work from home and high inflation and globalization challenges around the world, and you've built muscle in your organization, not to know what every problem will be in the future, but to take on new challenges as they come, then I think you feel a bit more confident. We don't know exactly what the future will bring, but we're going to find a way through it, because we've proven to ourselves, we've proven to our team, our customers, our investors, that we can be there with them even when times are challenging. And I think if you compare the resilience of companies, and not just in terms of financial resilience, but management mindset, capabilities in the organization versus 5 years ago, pre-COVID, companies have come an enormous distance, and that, I think that's given them some confidence. But no one's saying there won't be future shocks. I think if the last 4 years have taught us anything, is we better be on the opposite assumption. Something could come along. It's our job to be ready for it.
Rich, where does political risk rank in the list of concerns that CEOs have pointed out? There's a potential for, come November, a change in administration in D.C.
I do think that the uncertainty of politics and the disruption potential is much higher on the list. My sense of conversations with executives so far this year is their rank order of macro risk has flipped from a year before. If you go back to the beginning of 23, the list would have started with macroeconomics, inflation or recession, things like that. Second would have been China, US. Third would have been politics around the world. I think if you look at this year, you'd see the opposite order. It's politics around the world, starting with the uncertainty of the US and the massive division in US politics and how that can play out. But also there's elections in countries with more than half the world's population this year. It's not just in the US, there's a lot of uncertainty, and we have 2 wars going on. So that uncertainty is highest. Then I'd say US-China has stabilized a bit, but certainly still represents risk, as does concern around China specifically and whether its economy will rebound and when. And then third is sort of the broader macroeconomic risks, where it's not that there's no anxiety, but it's much dampened versus the year before.
And of course, when you think about the US and China, that push to some of these very high growth but sensitive areas in tech, and you look at AI, the talent that's needed to meet the needs for some of these companies, how confident are they feeling that they can actually meet the needs and get these highly skilled employees that they need to position themselves?
I'm so glad you surfaced that. I think talent more and more is top of mind for companies as they look to what they'll need to do to win in the future. I think that's part of the reason, even despite all of the uncertainties of 23 and constant negative headlines, we're heading to recession, we're heading to high inflation, the actual volume of layoffs among leading companies was remarkably low. And I think they realized that the cost of taking short-term action, anticipating a negative economy, was far outweighed by the cost of giving up talent that they would need for long-term success. And right now, it's about building digital talent. It's about reskilling and upskilling people, because as AI embeds itself in more and more jobs, then the colleagues in those jobs need to be able to take on different tasks, build new skills. I mean, this is an enormous challenge facing companies in the years ahead. It's also exciting because the more you can shift your workforce to the highest value-added activities and put automation or AI in for the rest, the more value per employee you're going to generate. It's probably one of the single biggest drivers of productivity over the next 5 years. So it's not a negative, but that doesn't make it easy.
Indeed, doesn't make it easy, but certainly that preparedness, putting the right pieces in place, certainly important. We do appreciate you joining us this morning. Rich Lesser, Boston Consulting Group Global Chair. Thank you so much.
It's a pleasure.
All right, coming up, all eyes on Nvidia earnings after the bell today. What this could mean for exchange-traded funds on the other side of this break.
We are counting down to Nvidia's quarterly results after the bell today, and you see the stock down nearly 2%. The stock has arguably been the most consequential to markets, accounting for more than a quarter of the S&P 500's gains this year. But any miss or failure to impress could ripple across ETF funds, ETFs with more than 440 ETFs holding Nvidia stock. Let's bring in Cynthia Murphy, ETF think tank director of research. She joins us for our ETF report brought to you by Invesco QQQ, and get to talk to you today. Give me a sense of which ETFs are the most exposed to Nvidia.
Hi, Akiko. Yeah, it's amazing how pervasive NVIDIA is across the ETF ecosystem. To your point, there's, more than 400, almost 500 ETFs that have exposure to it. And, it may not be in funds you would expect. So, you think about big tech, it's there. You think about semiconductor ETFs. They're huge NVIDIA allocators, like to the tune of one ETF. It has 25% of its entire portfolio just allocated to NVIDIA stocks. But then you also will find in things like big data funds. You will find it in, there's a minority impact fund, NACP, that has NVIDIA stock. You may find it in portfolios you don't expect it to see. But so that's why, as you're looking for your NVIDIA exposure, it may be all over your portfolio and you don't even realize. So any kind of, hits to NVIDIA stock could actually trickle down to all sorts of different segments that you may not immediately associate it with the stock.
So then, Cynthia, with that in mind, which have been the best performing ETFs that have NVIDIA in them?
So if you look at the semiconductor ETFs, NVIDIA is a huge component there. So they have really ridden that wave higher. What's interesting is I think we've been seeing a little bit of a halo effect of just the NVIDIA effect, which is part of the Mag 7 story. But it's ETFs, things like cybersecurity ETFs or software ETFs, ETFs that are associated with the AI theme, which is a theme everybody's been really excited about. They may not even hold NVIDIA. But just as a story of this is the future, this is where technology is going, and the chips, the semiconductors are a big story. NVIDIA is a big story there. There's been a halo effect that has boosted a lot of ETFs that are not NVIDIA holders or they have very little exposure to NVIDIA. QQQ itself has only 5% in NVIDIA, and look at the year it's had just thanks to that small allocation to that one stock. So it's been interesting to see some of these ETFs do really well, like cybersecurity ETFs have done really well. And they're not big NVIDIA holders, but they just fit within this AI theme that has been a beneficiary of that NVIDIA run as well.
So what's the way to play this? Is it to be in some ETFs that have exposure to NVIDIA, not necessarily outsized exposure, but also spreading your money around a bit to other AI plays that don't necessarily include the big chip maker?
Yeah, Kiko, I think the key here is to actually know what you're trying to do. So the worst thing you can do is be unaware of being really heavy on NVIDIA. So go make sure if you have NVIDIA on your if you have a semiconductor ETF and you have a big tech ETF and you have an AI ETF like a BOTS or Robo, and you have NVIDIA across all these exposures, you may be really loaded on that single stock. So now as we are faced with a potential correction, if guidance disappoints today, you could really be in a position where you are overly exposed to it. So I think awareness is the first step here. Make sure you are aware of how much exposure you have to a single stock for that single stock risk. And then it's a decision about, for the most part, everybody's still very bullish on the AI theme. And the consensus is that we have moved from hype to maturing as a theme. So, different parts should be benefiting, like software, big data. So, just pick the spots that you think are the next step to win, or stay broadly allocated, but just watch out for that single stock risk, because with a stock like NVIDIA, it may be all over your portfolio and you don't even realize it.
And obviously, we have seen a bit of a pullback ahead of the earnings coming out after the bell. But what sort of inflows have you been seeing from institutional investors versus retail investors who perhaps might be tempted to hit the panic button depending on what they hear coming out of earnings?
Yeah, Nvidia definitely is. It's a retail darling. It makes a lot of headlines. It creates a lot of buzz. So you tend to see folks more trigger happy when it comes to jumping in or out of that stock. That volatility sits higher among the retail investor. Institutions move a lot more slowly. They have long-term mandates. They tend to be way more broadly exposed for the long term. So you don't tend to see that kind of immediate knee-jerk reaction that you would definitely see among the retail crowd. I mean, we'll go on Twitter today and everybody's talking about NVIDIA. So it's a completely different experience, but you tend to see a lot of that too in the single stock in and out. I think you'd be less likely to see that from the long term, say a semiconductor ETF, something that's more of a long-term play. You may see less of a knee-jerk reaction there than you may see just directly onto the stock.
Yes, make sure people don't panic and really keep everything in context when they get those earnings results after the bell today. Appreciate you joining us, Cynthia Murphy, ETF Think Tank Director of Research. Thank you so much.
Thank you.
All right, well, we're also looking at shares of Toll Brothers popping after fiscal first quarter results. The building company reporting a 40% rise in orders, signaling a strong start to the spring selling season this year. Let's bring in Yahoo Finance's Danny Romero to give us the lay of the land. So, Danny, what are we seeing here?
Rochelle, Toll Brothers is kicking off the spring selling season with a bang. Sales and orders were up this quarter. Another thing to point out from the earnings call is that a few buyers are actually using the mortgage rate buydowns. That's when the builder upfronts the cost to lower the rate on the loan. That really stood out to me. Remember, Toll Brothers' customer base is really more affluent. So their priority is really to use those incentives either to upgrade their home or reduce their closing costs. And homes for the quarter actually closed with a price tag of over $1 million. Another strategy that Toll Brothers has been able to gain the market share really is using the spec strategy. That's when you build a home without a buyer in mind. And this strategy has been a success for Toll Brothers since most buyers really want to go move into a home as soon as possible. They don't want to wait for their home to be built. So this strategy really has been a win for Toll Brothers. Bottom line, Toll Brothers is not too concerned that if the resale market does unlock itself and more homes get listed on the resale market, Toll Brothers CEO pointed out that the majority of those homes that do get listed are about 45 years old. So that means that those homes will need to be renovated. That could cost more money and that could take some time. So really there's not too much concern that if the resale market does, unlock itself, that would some way hinder the new home market. Doesn't sound like it.
So Danny, what does this ultimately mean for the home builders as we look ahead to the spring selling season?
The spring selling season is underway, and this is usually a time when home prices actually go up, but some home builders have actually pointed away from that. Toll Brothers said in their earnings call that they will be cautious the next quarter. They will be increasing home prices modestly, especially that rates have remained elevated. Another thing to point out is that other home builders have signaled that they will not be pulling back on incentives like those mortgage rate buydowns. And, just for example, Lennar, D.R. Horton, those are the biggest home builders. They have pointed that they are not going to be pulling back on those incentives. Remember, these incentives have really helped drive the new home market. So this is really a good picture as we look into the spring selling season. Akiko.
Danny Romero with the very latest there. Thanks so much. Well, coming up, we got some big news coming out of Intel as they try to make a bigger place for themselves in the AI arms race. We'll give you the latest on the other side. We'll be right back. Intel making headlines at its first foundry event this morning. The company laying out a roadmap to become a leader in AI chips. Here with the details, we've got our very own tech reporter, Dan Halley. And Dan, Pat Gelsinger bringing in some of the big names in AI to make this announcement.
That's right, Akiko. Sam Altman, Satya Nadella, they're both being are a part of this announcement. Really, what we're seeing here is kind of Intel pushing its foundry services and AI, and they're basically saying, look, this is one of the first foundries of the AI era. You know, I mean, column A, column B, it's, you know, all kind of marketing at this point. But some of the important things that Intel points out is they say that they're going to be the #2 largest foundry in the world by 2030. That's what they hope to do. That would be behind TSMC. They also say that they believe that they'll regain process leadership with its 18A node in 2025. That means that they would be kind of the go-to company at that point. And they're also announcing their new Intel 14A process, adding that to the roadmap that they have. Previously, it had stopped at 18A, and the one prior to that was 20A. And I think, you know, when it comes to the foundry business itself, they say that they're unveiling an emerging business initiative where they're going to collaborate with ARM to provide foundry services for ARM-based systems on a chip. So they're moving forward with this foundry idea where, you know, they're not just going to be building chips for themselves, but for third parties, similar to what TSMC does. And so that's where they believe that they can become the second largest foundry in the world. And look, if they can pull it off, whoa, that's impressive. But, you know, 2030, it's 2024, so you got 6 years to pull it off.
So Dan, given where they are now, I mean, Intel's foundry segment isn't a very large part of their business currently. Do they actually have what it takes to be #2 in the world?
Yeah, I mean, look, their foundry services is, as far as, you know, revenue goes, in the millions of dollars compared to billions for their data center and their CPU offerings for consumers and businesses. And so, you know, it's obviously not the big part of their business, but it is growing to their benefit. And Pat Gelsinger regularly mentions on investor calls after earnings that, you know, we have such and such a vendor who's working with us on foundry services, but he doesn't drop the names of those companies. And that's something that investors, analysts have been hoping to hear more about, what these companies are that are supposedly working with, or as Intel says, currently working with them, or, you know, working out deals to work with them. So, you know, I mean, they could become a major player in the space if all goes according to plan. Now, you know, there have been some issues with the chip market as of late where companies have been pulling back on orders just because there's been some issues as far as, you know, there was first too few chips, then too many chips, and, you know, the PC market started to struggle. Now it's starting to pick back up, kind of, sort of, hopefully soon. And, you know, the AI market is really continuing to take off. We'll see if that can continue to do so. But, you know, if they manage to get all of their ducks in a row and continue to perform, then they could become this big foundry player. But, you know, right now, like I said, it doesn't contribute much as far as overall revenue, and getting there is going to be difficult, and will mean really getting more and more customers on board, and hopefully they tell us who they are.
Indeed, because of course for now TSMC really holding that crown pretty steadily there. Appreciate you getting us up to speed, our very own Dan Howley. Well, shifting gears here, today we're looking at the Teamsters Union workers striking at Molson Coors in Texas, and next week 5,000 workers at Anheuser-Busch expected to walk out. Now this builds on the strike momentum which surged last year. Over 460 strikes in 2023. That's up from the year before, according to a report from Cornell and the University of Illinois. For more on what we might see from unions this year, we have Seth Harris, former top labor policy advisor to President Biden, senior fellow at the Burns Center for Social Change, and distinguished professor of practice at Northeastern University. Thank you for taking the time to join us this morning. And so as we look at the strike momentum, already seeing it as we've seen with the workers at Molson Coors here, but why do you think we're going to continue to see this in 2024?
Well, I think workers are still very angry at corporate profits far outstripping the increase in their wages. They were hit by inflation over the last year or two, or really 2 years. and their real wages have only begun to go up over the course of the last year. At the same time, corporations have been making epic profits, and that is a consequence of their hard work. They're also still very angry about what happened during the pandemic, where they felt they didn't get the respect or the protection or the help that they needed from their employers. And so they're banding together and demanding contracts, as they did in 2023, when we saw some of the most important improvements in collective bargaining, some of the best contracts that workers have seen at companies like UPS, the big three automakers out in Hollywood. So I think we're going to continue to see that in 2024. Maybe not at the same level, probably at a somewhat lower level, but I think we're still going to see activated workers going out on strike.
Seth, the thinking over the last few years has been that this union movement has gained momentum partly because the labor market is so tight. The thinking is that these companies need these employees. Do they still hold that leverage today at a time when we've seen so many companies in cost-cutting mode?
Well, they do, because we still have very tight labor markets, although that's not the entirety of the story. Unemployment's still below 4%. It's been below 4% for the longest period since the late 1960s. Workers quit bad jobs, got good jobs, and are now really settling in. But a lot of what we saw in 2023 was not merely a consequence of a tight labor market. It was workers in industries where there were barriers to entry for workers who might replace them. You know, you can't just walk in off the street and build a car. You can't just walk in off the street and write a television script. And so those workers had an immense amount of power in their dealings with their companies. Other unions, like the Teamsters at UPS, had such a gigantic number of workers involved that replacing them was just inconceivable. You were not going to find 330,000 truck drivers to replace the Teamsters at UPS. So those unions had an immense amount of power going into their negotiations with their unions. The same thing could be said in the healthcare sector. Now, in other sectors like the fast food sector, companies like Starbucks in warehousing with companies like Amazon, there's not quite as much worker power because those workers are much more readily replaced. And so there is a danger for those workers if they go out on strike. Now, they can do short, targeted strikes, strategic strikes, and they did that, and it was very effective. But it's not quite the same as the UAW taking 50,000 workers out to the picket lines.
And Seth, as you mentioned, there's a lot of nuance here. For some of them, it's about sort of making up for some of the concessions they made during the great financial crisis when it came to the auto workers. But when you look at, say, the actors' strike, some of that was also about future-proofing their industries as well. How much does that factor into some of the costs and some of the pushback that we're likely to see from companies, especially when you think of just being at the beginning of what large language model AI can do?
Yes, that's an extremely important point. A good bit of what happened with both the actors and the writers in Hollywood related to the use of artificial intelligence in script writing, in the images of actors being duplicated and triplicated and being used in crowd scenes and other ways. And so the unions negotiated protections for their members. That is going to be an issue in some industries. I don't think we know the breadth of the effect of AI on employment just yet, but it's certainly going to matter in industries like journalism and other information sector industries, and also industries that rely very heavily on data. For example, in the technology industry with coding, I think it's going to be a very, very important application. So the question really that will come up at the bargaining table is, will technology be used by employers to cut costs, to lay off workers, or will it be used in a complementary way with the workers that they have to make those workers more productive, to create more job opportunities, to help those workers to increase their wages? That's exactly the kind of issue that collective bargaining is well positioned to help address. The problem is 89% of American workers don't have a union. And so those issues will be addressed by non-union companies in a way that maximizes their profits rather than maximizing their workers.
Seth, we'll have to have you back on to talk about what's happening in our own industry and journalism with the organization happening in newsrooms there as well. Really do appreciate your insight today, Seth Harris, former top labor policy advisor to President Biden. All your markets action ahead. Stay tuned. You're watching Yahoo Finance. Fubo TV filing an antitrust lawsuit against Disney, Warner Brothers, Discovery, and Fox, the sports streaming platform, alleging the joint venture between the media companies is anti-competitive. David Gandler, co-founder and CEO of Fubo, spoke to our morning team earlier, criticizing the new alliance.
To me, this is almost borderline racketeering, because what's happening in the industry is that, the media companies are saying, look, if you want the full bundle, go get a pay TV subscription. And at the same time, they're taking certain pieces of content out of the bundle to force a consumer to get that one extra game or two extra games to pay for another service. So they're basically double paying in more than, I would say, 30 to 50% of cases for the same content.
With media giants clamoring to make streaming agreement deals with one another, this is just a new type of cable. To break this down for us, let's bring in Yahoo Finance's very own Ali Canal. Ali, remember the argument when streaming started that this would be a cheaper alternative? It feels like we're going back in time now.
Oh yes, Akiko, it seems like everything old is new again, but we are entering what seems to be this new era of the streaming bundle. And just to put this all in perspective, bundling is nothing new. We've seen bundling before. Companies have been doing this with their own content, their own services, but the move towards partnerships among competing companies is clearly a shift in strategy. We have the WBD, Fox, ESPN, joint venture. We have reports that Paramount Plus and Peacock could potentially team up for their own streaming partnership. And this is all coming as these companies face more pressure from investors to scale their streaming services and reach profitability. At the same time, we also have increased competition from tech giants like Amazon and Apple, which have just gobbled up a fair amount of streaming deals out there, largely due to the fact that they have the cash to do so. So in some ways, these legacy players are joining forces to really protect themselves against big tech, because that's really the only way they can compete. Now, as we've seen with the Fubo TV lawsuit, I do think there is going to create this is going to create a lot of noise. The Justice Department is reportedly looking into the WBD, ESPN, Fox venture to really determine whether or not it violates any antitrust practices. And on top of those concerns, there's also the question of whether or not these competitors sharing content, how they can do that without giving away all the goods, right? Disney is one example of this. They are also planning to take ESPN fully over the top in fall 2025. And that's on top of the JV partnership with WBD and Fox. So are consumers going to pay for both? Pricing is another concern. How much is this going to ultimately cost the consumer? Will people pay for an a la carte service if they can just opt into a bundle? So overall, a lot of question marks here as this continues to evolve, but it's definitely a big turning point when we think about the future of streaming and really the industry at large.
Indeed, fascinating stuff there. Thank you for getting us up to speed, our very own Ali Canal. Well, if you're trying to watch your funds, consumers might be underestimating how buy now, pay later services impact their credit scores. With that in mind, we're taking a look here about what providers report to credit bureaus. It's not the same across the industry. To break it down for us, Vanessa Wong, Market Watch reporter, is here. Thank you for joining us, Vanessa. So I'm looking at your article here because there does seem to be some misperceptions here around the impact of buy now, pay later services, whether they help or hurt your credit. Break some of that down for us.
It's really interesting. So there was a new New York Fed report that was saying there are some consumers who are turning to buy now, pay later services, thinking that it will help them build credit, which at this point is still not true. And that's because buy now, pay later providers typically are not reporting their users' payment data to the credit bureaus. It's inconsistent. There are not standard rules right now for how any of this data is treated. So I reached out to the large buy now, pay later companies. Klarna says that they don't report anything to the credit bureaus. Afterpay also doesn't report anything to the credit bureaus. Affirm reports some, but not all data to the credit bureaus and not to all the credit bureaus. So there is at this point still sort of like a motley landscape in terms of how buy now, pay later data is dealt with. So specifically, Affirm reports monthly installment payments to Experian, but it does not report payments for its pay in 4 plan, in which your total balance is split into 4 payments to any of the credit bureaus. Once it gets to the credit bureaus, how they deal with it is also not standard. So I can go into that a little bit if it makes sense. TransUnion says it doesn't. TransUnion was saying
really quickly, it doesn't help your credit, but does it hurt your credit if you don't make those payments in time? Because that's always been a bit of a concern as well. You know, where do you take the hit?
At this point, it does not show up on in your credit score. So Experian was saying that buy now, pay later transactions, those payments will show up on your credit report. However, it does not get factored into your score at this time. So it won't, at this time, help or hurt you. If you're not making your payments on time, though, you do have your debt snowballing, which creates other problems.
So Vanessa, then, in terms of sort of financial education about this, how much of that falls on some of these companies? How much of that is clear when people are making these purchases of what they're getting into, especially for some of the ones that offer interest, like Affirm, depending on the size of your payments here? How much do people actually know about what they're getting into?
I think because buy now, pay later is still a relatively new service, there's still a lot of confusion about what is going on. And I think because there are different payment plans, for example, with Affirm having a monthly installment payment plan or a pay in 4 payment plan, which is dealt with differently in terms of how it's reported to the credit bureaus, it's just rather confusing. So there are consumer advocates who believe that using a credit card, which has established reporting standards with the credit bureaus that many people are used to sort of like how they're dealt with, which actually do help you build credit if you're making on-time payments, is a better option for folks who are trying to build their credit.
Well, certainly appreciate you joining to clarify some of that for us. I know a lot of people using it for things like, even small things like groceries, so certainly important to see how those things add up and affect credit. Appreciate you joining us, Vanessa Wong, Market Watch reporter. Thank you so much.
Thank you very much.
All right, let's get you a quick check of the market. Still looking at red across the board here. So still seeing some investors pulling back a little bit as we await those Nvidia earnings after the bell. And of course, also bracing for what we'll hear from the Fed minutes coming out this afternoon, looking for any sort of morsel about the potential for the discussions around a rate cut, the next rate cut coming up this year. And so, Akiko, what else are you going to be keeping an eye on as we head into the noon hour?
Yeah, I mean, it really is all about Nvidia, right? At the end of the day, we're going to be watching the chip makers to see where the knock-on effects are going to be on that front as well. But Fed minutes certainly going to be key as well. We'll be watching to see where the Treasury market moves on the back of any nuggets on a potential rate cut. That's it for Rochelle and I in the 11 a.m. Eastern hour. Much more to come here on Yahoo Finance. Keep it right here.